valuation for solid minerals only. This is what we're talking about. It sets out a required minimum standard for public reporting of the value of a mineral asset. The mineral asset can be considered any exploration or mining right or entity holding such property or the securities of such an entity. I'm going to take you through the following points that you see on the slide and try and give you an introduction to the SAMVAL code through those points. We won't cover everything, but as I said, at the end we can engage. So let's talk about a bit of history. The process for establishing SAMVAL was initiated through an open meeting at a SAMVAL colloquium in March 2002. The colloquium called for comments following various papers and articles that were then published. And input was also solicited from the Australian Institute of Mining Metallurgy, the Canadians, the Americans. And then in 2009, a maiden SAMVAL code was published, and then there have been subsequent amendments. Sorry, that was in subsequent amendments. The maiden one was in 2008, and there was amendment again in 2009 and 2016, forgive me. This slide shows the people that have been involved with the latest update. The code has been, over the years, the code has been incorporated as part of the JSE requirements into their section 12. And we continue to work with the JSE and various international bodies to try and seek alignment. In fact, I'm just going to read here some notes as to why we updated in 2016. So there are a couple of points here. We wanted more detail into the code. We wanted more alignment with international bodies. We wanted to increase the scope a little bit to include other valuation purposes. We included reasonableness as a value, as a principle. We'll come to that a bit later. And then another important one is market value. We settled on market value as a value. There was some discussion in 2011, I believe, around what are we actually putting forward as value. Right, let me not carry on there. So the basis of the SAMVAL code. Let's talk about application and purpose. The code provides consistency, minimum standards, and guidance to limit unscrupulous valuations. It is applicable to the preparation and reporting of mineral valuations. The valuation should be performed by a competent mineral asset valuator. We'll refer to that person now as a CV. It should be based on best practice and generally accepted valuation standards. And the CV should disclose all relevant and material information in Table 1. I'll talk a little bit about Table 1 later. I haven't included the table in this presentation, but it is in the code. It is applicable to all types of solid mineral commodities and styles of mineralization. And the valuation of oil and gas assets is dealt with separately in SAMOG. In terms of scope, the scope is limited principally to the valuation of mineral assets, including the valuation of mineral resources, mineral reserves, at any point on the value curve. And it also includes property associated with the asset being valued. SAMVAL applies to public reports like annual reports, quarterly reports, JSE circulars, expert reports, technical papers, and the like. Where compliance standards from other jurisdictions are relied upon, this should be disclosed. So if you're doing a valuation, you need to bring that in. Reliance on non-public documents, information that is not code compliant, should also be disclosed. So relationship with SAMREC and other codes, I've got a nice little slide later on that just shows you where it fits in. Valuations are based on mineral resources and mineral reserves. So if you want to do a valuation, you need to It's those things we're putting a value to. So it's linked to SAMREC or other CRISCO-affiliated reporting codes. I've mentioned this, alignment with other jurisdictions. SAMVAL has, as far as possible, been aligned with other mineral asset valuation codes around the world. In convention, you'll notice that the word in the SAMVAL code and in the SAMREC code, we use the word should and shall quite a lot. When you see the word shall, you're talking about that provision being mandatory. When it should, it is preferred. So that's a bit of a distinction between those two words. Limitations on the use of valuation will be defined by the commissioning entity. I'll talk a little bit about the commissioning entity a bit later. Purpose of the valuation must be clearly and unambiguously stated. The valuation is only valid at the effective date, which must be stated. The valuation is intended for a specific purpose at a specific time and may not be suitable to another purpose at a later date. Valuation of companies, which may include other assets such as real property, personal property, business combinations, which requires other competencies. This may be out of scope. And we'll talk a bit about when you can include other assets later. So if we talk a bit about the purpose of valuations, there's a number of different reasons. I'm just going to read out a few here. It's for raising debt or equity finance, to facilitate negotiation between parties who may be wanting to engage, assessment of government charges and taxes. You can use them, you need a valuation for estate settlements, internal corporate reports, litigation, acquisitions and disposals. I'm not going to go on, it's quite a long list. So moving on to the principles of the SAMVAL code, this is one of the areas that was looked at again when for the 2016 release. And then I'm not going to talk about the fundamental ones, but there are in the guidelines other principles around impartiality and reasonableness, and responsibility. But let's just talk about the fundamental principles. Materiality. This is talking about relevant information for reasoned decision making. It's important that when you put together a valuation, you concern yourself with the things that are going to drive that value and ensure that you bring that information in so that whoever reads your report is in a position to understand how you came to your final answer. In terms of transparency, the reader of a public report must be provided with sufficient information, the presentation of which is clear and unambiguous, to understand the report and not be misled. Process and methodology aligned to the process of the valuation and should be auditable. I've read that off the screen, but quite frankly, it's very similar to materiality. Not only must you demonstrate materiality, when putting a report together, you must be transparent. Don't disguise or hide or leave things off if it is necessary, if that information is necessary for the person to make an informed decision. Competency, that goes without saying. We do have a code of ethics. And we rely a lot here, the onus lies a lot on the competent valuator himself to be able to demonstrate competence, and he should be able to justify the work he's done to his peers. You should also be registered with an organization that has a code of ethics. So an enforceable code of ethics for that matter. A couple of those organizations would be SAME, the GSSA, Plato, EXA, SACNASP, and SICA. We'll talk about reasonableness, the fourth one that's been included now. This test, a good reasonable test is to identify a valuation which may be out of step with industry standard and norms. So another way of explaining that is, stand back from the problem and look at what results other people are getting. Don't just accept what you compute. Assumptions and model relied upon should be reasonable within the context and purpose of the valuation. Other appropriate qualified and experienced CVs with access to the same information as of the same effective date would arrive at broadly comparable valuation range using the same basis of value and the same scope. Goodness, it's a mouthful. But what we say in there is that if you had to give all your data and the stuff you work with to someone else, would he come up with a similar answer? That's also a test of reasonableness. So let's talk a bit about the process of valuation. I'll talk a little bit about the definition and then move on to the approaches and methods that people generally use. I'm not going to hop on them. And then I'm just going to comment on a few things. So valuation is the estimation of the value of a mineral asset in money or monetary equivalents. The basis of valuation is the monetary value of the mineral asset being valued and may vary depending on the value type being assessed. In extractive industries, value is usually derived from an assessment of the intrinsic value, which is based on the unique technical characteristics of the asset being valued. The CV must provide a clear definition in the valuation report when some other type of value is required. For example, fair value as opposed to market value. So if you're including something else, you need to get it talks to clarity. You need to define it and make sure there's transparency there. In order for intrinsic value to be converted to a market value, appropriate and justifiable market factors are usually applied. And now with 2016, we talk about market value. So this table is actually in the code, and it talks about three approaches. When you do a valuation, it's good practice and it's a requirement to use more than one approach. These approaches depend on where you are in your development curve of the asset that you're trying to put a value to. I'm just going to read out the basis of each one here. So the income approach relies on the value in use principle and requires determination of the present value of future cash flows over the useful life of the mineral asset. I think everyone's pretty familiar with that. The market approach relies on the willing buyer, willing seller principle and requires that the monetary value is obtainable from the sale of mineral asset is determined as if at an arm's length transaction. Quite frankly, you're going into the market and you're getting data related to value in the marketplace, and you are comparing your property with data in a rational means, in a rational manner. And then there's the cost approach. This relies on all historic and or future amounts spent on the mineral assets and is a valuation approach based on the economic principle that a buyer will pay no more for an asset than the cost to obtain an asset of equal utility, whether by purchase or by construction. So what does it cost to get that asset to that point of value? So this table is for guidance. The CV must decide and stipulate on the basis of the data, which is the most appropriate approach and method. you need to explain why you've used or adopted that particular method. The relevant technical and related parameters, including modifying factors, should be disclosed. Understandably, a risk assessment should be conducted to highlight this uncertainties associated with the resources and modifying factors. There's a comment at the bottom of the table that says, when not possible, the approach taken should be justified. There are instances where you might find it's very, very difficult to use two different approaches to put a value to a property. In an instance like that, you just have to explain very clearly how you've gone about it. These are different methods. As I said, I'm not going to go into them. I'm sure I recognize a lot of the names that are listening, so I'm sure most of you are familiar with this. Otherwise, you can go and read up on it. What I can say is that in the market approach, the gross in situ value is generally not acceptable in terms of SAMVAL. This is what I've written here is the use of gross in situ value simply determined from the product of the estimate of mineral content and commodity prices is considered unacceptable and inappropriate for what we're trying to achieve. But I said I'm going to talk about make a couple of comments. These things are in the code. The first being highest and best use. So the IVSC considers the concept of highest and best use to be a fundamental and integral part of market value estimates. I'm going to talk to land here. The unique characteristics of land determine its optimal utility. It is immobile, permanent, and each has a unique location. Land will normally outlast uses and improvements that contribute to value at any particular point. So when you value a piece of property, it can change and go up and down. Market value of land based on highest and best use reflects the utility and permanence of land in the context of a market with improvements constituting the difference between land value alone and the total market value. So if we now look at SAMVAL, SAMVAL considers a mineral asset valuation where extraction will take place, but there may be circumstances where other uses may be possible, like defunct mines, agricultural ground over which mining is contemplated, and non-mineral uses of the land may need to be considered. Additional value can also accrue due to a change in exploration, development, or operating strategy. This could include highest and best use is considered if part of the brief, but only when the source of value is physically possible, appropriately justified, legally permissible, and financially feasible. Where highest and best use is necessary, the CV may need to rely on other experts. I think that's self-explanatory. Moving on to scoping studies. A scoping study or preliminary economic assessment is defined as a study other than a PFS or a feasibility study that includes an analysis of the potential viability of mineral resources and includes appropriate assessments of realistically assumed modifying factors and operational factors that demonstrate that progress to a PFS can reasonably be justified. A scoping study cannot be used to estimate mineral reserves. We all understand that. Only inferred, indicated, or measured resources can be used in a scoping study, not exploration results, targets, or mineralized targets. The accuracy of input assumptions is recognized as having a low level of confidence, and the risks associated with a low level of accuracy and confidence should be disclosed. Mineral resources require a realistic prospect of eventual economic extraction. and this requires the application of appropriate level of consideration of potential viability based on reasonable assumptions and forecasts, resulting in a basic cutoff grade calculation. The CV should be aware of this and be able to justify it. Now let's talk of the use of mineral resources and mineral reserves. All exploration results, mineral resources and mineral reserves should be included in a mineral asset valuation. The approach selected will depend on the confidence in the mineral resources and mineral reserves, and we spoke about that earlier on in the table. Proved and probable mineral reserves, measured and indicated mineral resources are generally used for the income approach, with cognizance taken of the following. The mineral resources and mineral reserves shall be estimated and confirmed by a competent person. They shall, note the word shall here, be relevant on the effective date of the valuation or need to be suitably qualified. Use mineral resources if mineral reserves are also present and in general are scheduled in the mine plan ahead of the mineral resources, provided that the mineral resources as depicted are likely to be economically viable. Mineral reserves should be based on a life of mine plan for an operating mine, or at least a pre-feasibility study for a mine project. Where measured and indicated mineral resources are used, the technical and relevant parameters used should be estimated, confirmed by one or more CPs, and should include a statement about the level of confidence of the parameters relative to the level of accuracy and confidence of a PFS. A higher level of risk or uncertainty should be recognized if the technical parameters are not at the equivalent level of accuracy and confidence as a pre-feasibility study. So all these comments are really about transparency and competency. Markets attach a value to inferred mineral resources during the exploration phase. So inferred mineral resources may also be mined in an operating mine and need to be taken into account in the valuation. So this happens. You obviously can't use an inferred mineral resource and convert it to a reserve, but it can be included in the valuation, and it's good practice to show your valuation with and without inferred minerals in it. You know, if you developing through an inferred zone to get to an area where your measured indicator or your main ore body sits, you know, that's going to come up. And if there's a lot of that material in your ramp up to steady state, it could be problematic in the valuation. So this is an area where you really got to apply your mind and be transparent about what you've done. Where evaluation is conducted on inferred resources, exploration properties and or exploration targets, the CV should qualify the valuation with a clear statement of the value, of the level of confidence and the risks associated with the valuation, the reason for the application of the approach and method, the reason why the valuation may or may not be based on a SAMREC compliant report, the application of more than one approach and associated method, the modifying factors applied, unacceptable to use potential resources or any other categories that do not conform to the definitions of mineral resources in SAMREC or CRISCO. Where mineral resources are valued by the income approach, the CV must justify the usage and indicate the risks associated with the valuation. These are do's and don'ts. Where mineral asset valuation is reliant on exploration results resources and reserves, these should be compliant with SAMREC and or other CRISCO-affiliated reporting codes. Now, we have spoken about that. And they must be defined by the jurisdiction or commissioning entity. I'll put this slide up. I believe that the CV, when looking at value, should always be mindful of the design or plan behind that you actually behind the asset you're actually valuing. The plan that talks to your modifying factors. You need to be a little bit sighted and understand how that plan contrasts to reality. If you're unsure, you should be using experts to give you better insight so that you can apply your mind properly as a CV. Moving on to risk in valuations. I'll talk a bit about risk, uncertainty, run through a couple of risk factors that should be considered, and then talk about a list of techniques, risk techniques. So uncertainty is a measure of our inability to assign a single value to a possible event. It can be defined as the variety of possible outcomes, gains or losses, around an expected value. The quantification of uncertainty is the difference between the true value of an outcome and an estimate of its value. The CV should highlight uncertainties in a way an informed layman can understand. I'm going to move down to risk now. Risk can be considered as a state of uncertainty with the potential for undesired outcome or financial loss. In a valuation context, risk refers to the probability of an undesirable financial outcome. Mineral asset valuations are inherently risky in terms of the confidence of the inputs, assumptions, estimates, and forecasts. So the CV should conduct a risk assessment of the valuation using appropriate techniques. And you're talking about the three things you're looking at. That's your revenue forecast, your capital forecast, and your operating cost forecast. So risk factors to consider include a number of things, and I'm going to run through a few here. Economic factors, legal considerations, financial considerations, government factors, the ability to meet annual production targets, so that would be a production-related factor, the realization of the recovered grades, so you're expecting certain grades, and are those the ones that are actually going to materialize? What sort of dilutions involved there? Maintenance of stripping ratios when you're working with an open pit. There's a whole host of these things. So hopefully that gives you a flavor. Then some risk mitigation strategies may include the use of contingencies. So if you've done your work and you recognize the risk, you could arguably provide for a contingency in your valuation so that the risk is mitigated and thereby reduced to some extent. There is a process that you go through. You could put in place hedging if you're talking to the prices or maybe the expense of certain items. And then there's option pricing. And I'm sure there are lots of other mitigation strategies we could discuss. Looking at risk assessment techniques, let me just click that down there. There's a whole bunch of them. There's a qualitative risk assessment. That's where you're able to put a value to the level of risk taken into consideration, likelihood and consequence. A single variable sensitivity analysis. I've actually got all the definitions here, but I'm not going to flog through them. In all instances, what you try to do is demonstrate how exposed that particular driver is in your valuation. Range sensitivity analysis, probabilistic sensitivity analysis, and probability of survival. Types of risk. I'm not going to read to that list on the presentation, but there are a number of different types of risk, and it really is everything that goes into your financial model. Where you don't have absolute certainty about the number you're using, that number's at risk. It's at risk of being different. There's uncertainty around it, and then you can get a measure of risk around that uncertainty. Right, moving on. So I said I'd touch on the commissioning entity. This is the organization, company, or person that's commissioning a mineral asset valuation. The commissioning entity should establish the skill, experience, and knowledge and ability to perform mineral asset valuations. The commissioning entity and the CV should agree in writing to the terms of reference in value the purpose of the mineral asset value, its objective, and the access and disclosure requirements, and any relevant assumptions, premises, or constraints that may apply. The commissioning entity and CV should agree what level of disclosure will include in the valuation report, but this should not constitute undue influence bias in the manner in which the mineral asset value is undertaken. The commissioning entity must confirm in writing to the CV that complete, accurate, and true disclosure is made to the CV of all material data and relevant information, that the CV has reasonable access to records and personnel to ensure a proper valuation. The commissioning entity must inform the CV of confidentiality of information supplied and the extent to which it may or may not be disclosed. The commissioning entity should not unduly influence the outcome of the mineral asset valuation. A public report concerning a company's mineral asset valuation is the responsibility of the company acting through its board of directors. This report should be based on and fairly reflect the mineral asset valuation report and supporting document prepared by a CV. A public report should disclose the name of the CV and their qualifications, experience, and registration with the relevant professional body. Where a public report refers to the valuation documentation, written approval of the CV must be obtained with regard to the form, content, and context in which a document is included. Sometimes a commissioning entity may require the CV to disclose and display independence, meaning that other than professional fees and disbursements received with respect to the mineral asset valuation, the CV has no pecuniary or beneficial interest in any of the mineral assets being valued, or is associated with the commissioned entity or any holder of any right in the mineral assets being valued, and which could create the apprehension of bias, which may or may not be in writing. Gosh, I've read through a lot here. For me, this is a very important part of valuations, and a very important part of maintaining your independence. I spend an enormous amount of time not coaching, but managing the expectations of my clients when it comes to valuations, and all these points that I've made, I use them rigorously to keep those boundaries in place. So let's move on. Let's move on to the competent valuator. A competent valuator is a person who possesses the necessary qualifications, ability, and sufficient relevant experience in valuing mineral assets. A person being called upon to sign as a competent valuator must be clearly satisfied in his own mind that he is able to face his peers and demonstrate the competence in the valuation undertaken. So what does the competent evaluator do? I'm going to, on the next slide, talk to these, about the role of the competent evaluator in terms of his basic qualifications and being registered. I'm going to hop a little bit on ethical awareness and then governance. So I mentioned I'd put the slide up a little bit later. Earlier I mentioned it, and it just shows you where SAMVAL applies and in interaction with SAMREC. And so the occupational task of the CV, what does he do? He puts a value to mineral assets. He looks at the valuation of mineral assets, interests, considerations, whether used for litigation, disputes, or as an expert witness. He takes responsibility for the valuation portion of a public report. A competent evaluator is a little bit different to a competent person. When you talk about a competent person for mineral resources, you make reference to having 5 years of relevant experience around the type of deposit that you are estimating. But a competent value, we talk to having sufficient relevant experience. And we must bear in mind that a competent evaluator can rely on specialists, and he should rely on specialists to support him in areas where he's uncertain. And then he could even have a team of these people, and he must sign off as the leader of that team and as a competent evaluator. So the CV or the competent evaluator should be able to, let me run through these, identify the mineral assets being valued in terms of the valuation scope and purpose. So what is it I'm putting a value to? Determine the market value of that. You should be able to apply the principles, standards, and requirement of a mineral asset valuation. These are in the code. You should be able to identify the value to be determined from the underlying mineral assets and the associated benefits and costs, that there is a price determined by argument, debate, and negotiation. The difference between value and price. You should be able to select and apply appropriate valuation approaches and justify that the approach is reasonable. The CV should be able to justify the adopted approach to peers and understand the associated implications and conclusions. It should be able to understand, appraise, and analyze modifying factors. Should be able to engage suitable specialists as required to prepare and be responsible for their inputs into the valuation model. The CV should practice across international boundaries and be familiar with local jurisdictions and international best practices. So a lot of those comments now were repeats of what I said earlier, but they talk to the competence required. And then I think one of the things important to me is that if you don't know, find out, and make sure you know what you don't know. When considering the responsibilities of the CV must assess all of the data, information, interpretations used in the mineral asset value and apply judgment to the relevance, reliability, and quality of the input. So he must weigh up the information he's using, not just mechanistically apply it into a sausage machine. Where a mineral asset valuation is a team effort and there's clear division of responsibilities within the team, each technical expert should accept responsibility for their contribution. Notwithstanding, he still remains responsible for the overall evaluation. That is the CV. The CV must clearly state where other people's work has been relied on and identify these persons. The author of a valuation report must be satisfied that their work has not been unduly influenced by the commissioned entity. For me, that's an important one. The author of a valuation report should ensure all relevant assumptions, premises, and constraints are documented and make adequate disclosure of all material aspects. So the CV accepts overall responsibility for the mineral asset evaluation that has been prepared in whole or in part, and that permission has been granted to utilize this work, and that the work of other contributors is acceptable and has been signed off by such contributors. Again, I repeat myself, but it is important. In the valuation of a going concern company, some accounting values may be used in the valuation, example, goodwill, intangibles, etc. And although the CV may be part of a larger team, they should acquaint themselves with the relevant IFRS definitions. The CV must ascertain the ownership of the mineral asset, whether the property is held as a right or freehold, whether restrictions on rights and agreements will influence the valuation, and include inter alia such as security of tenure, access servitudes, royal payments, joint ventures, etc. That goes to a number of other things. If you are looking at a value, you've got to concern yourself with everything that impacts value. So if the commissioning entity or has certain obligations and these assets are attached to those obligations, then certainly you need to appraise yourself. So these comments here, I make them, but they're not completely holistic, however you verbalize them. Assessment should be made of the land value if relevant to the valuation. And that talks to what the commissioning entity has asked for. A site visit should be undertaken by the CV, and if not, reasons should be given, which may include non-materiality. The valuation date must be provided as assumptions, premises, and forecasts used are only valid at a specific point in time, as is the valuation. Let's talk a bit about registrations. I think I mentioned earlier, you need to be part of some organization that has a code of ethics that are enforceable. I think I mentioned EXA, SACNASP, and the like. There are interim arrangements where if you're a member or a fellow of SAIM or the GSSA, you can do a valuation, but subject to a peer review process confirming. So let's talk about ethical awareness. I've got no notes here because this is a hobby horse of mine. I believe that this whole SAMVAL code is there to provide guidance, but the CV himself will know whether he's putting an appropriate value down on paper, and he's doing the right thing. I own a building here in Marshalltown. If I flogged it tomorrow because I had to flog it quickly, I'd probably get about 2 million. If I rebuild it, it'd cost me 30 million. If I went to the bank to loan money, they might give me a valuation of 10 million. That's a huge range of value. In my heart, I know I'd probably get about 6 million if I try to sell it over the next year. So I should never try and put a value of 30 million to the thing. I can talk about the range of value, but pick that value in the middle that's the most appropriate. That talks to being ethically aware and mindful of the impact your guidance and your results have on other people and other circumstances. So maybe perhaps we can talk about this a little bit more later on. But if we understand why these codes are put down in the first place, they were established because of certain things like the Brex scandal and because of bad behavior of people, where the global industry is saying, come on, surely we can exercise a little bit more control. It's sad that we have to be controlled if we're professionals, but that's the case. So biggest driver is our internal driver and that talks to ethical awareness. We do have some governance in place. There's compliance monitoring. As I said, the codes have been incorporated in the JSE listing, so they're requirements, and they say that if you certain things you must reveal and include if you write a valuation report. And this is true. So CPRs and the ongoing requirements. We've got a readers panel that the JSE have set up, where external specialists review the submissions and give feedback to the JSE. And the feeling is that this prevention is better than cure. So I'd rather pick things up before it's too late. And you know, no one really wants to be enforcing a stick and striking people off a register because they've got it wrong. Rather pick things up earlier, discuss them and fix them ahead of time. The SAMCODES has multiple tiers of governance. So you've got compliance, a link to your membership condition of your organizations. We've got recognized professional organization systems, that's internationally. So when you're working outside the South African jurisdiction, there's reciprocity with other organizations. There's statutory bodies that have certain requirements. And then, as I mentioned, the JSE Readers Panel and the JSE requirements. If anyone comes across something remiss or something that's incorrect, badly done, or a transgression, you can put a complaint in writing to the SSC. And the ethics committee then will decide whether the complaint is valid. And then it'll be referred to the respective professional organization for discipline. For me, this is where prevention is better than cure comes in, and where ethical awareness is important. And we need to raise that amongst ourselves. I've got comments here about a recognized professional organization, but I'm sure we all know what that is. If not, we can discuss it later. So let me talk about Table 1. If you go to Appendix A, you'll find Table 1 there. And really, it's a bit of a checklist. If you put in your report together, after you've done your work and you now want to report on that work, you need to cover a whole lot of requirements. The other type of checklist you should also use is the one from the JSE. It's a high level, so it talks to the minimum information that must be in. And the checklist should be considered in terms of an if not, why not principle. And as always, relevance and materiality are overriding principles that determine what information should be publicly reported. Sufficient information should be provided for a reasonable and balanced assessment of the significance of the information, and all material matters should be reported, particularly where inadequate or uncertain data would affect the reliability of or confidence in a valuation statement. Again, we've spoken about all this. It's uncertainty, risk. How did you get your value? And why? Why is that the value? If you're silent on something, people want to know why not. So if you have a supporting competent person's report on reserves or resources, you can append them to your valuation report. In fact, you should do so. The valuation method selected for the mineral asset valuation should be valid, tested, use accepted definitions of terms and procedures, and be best suited to the valuation of the asset in question. Ideally, I've mentioned earlier that if you need to use some other methodology, because these aren't, they're not apply compliant, or then you can't use them, then you have to be absolutely clear as to why you've taken a different approach. So that's it. Tanya, over to you. We can address questions and talk in general.
Thanks very much, Vaughan. Okay, anybody who'd like to ask questions, please raise your hand. Our first question goes to Rodney. Rodney, quick.
Hey, Vaughan, can you hear me?
Yeah, I can hear you.
Good. Okay, so let's take a scenario. We've got a mine. It's been running for a number of years. It goes into care and maintenance. It's got a 20% reserve on it. The rest of the life of mine, so 80%, is an inferred resource. And you as a valuator are asked to give that asset a value.
Mm-hmm.
So then you can easily, do the discounted cash flow on the reserve is very easy. You've got historical costs. You high confidence on that reserve portion of the asset. What do you do with the 80% of inferred resources now, which, is very subjective? And so often in this industry, you'll find an asset like that, and the inferred resources are higher grade than the reserve. Everything is all the value is pushed into that inferred resource part of that asset. How do you merge those two, where you've got those two sort of different confidence levels?
Okay,
value.
Rodney, let me answer you there. So I'm going to go back to the commissioning entity and talk about the guy who he approaches me and says, look, I need a value like you are. I've got this asset and I need a value. My first question is why? What do you want the value for? Is it for your own personal understanding? Then I can be a bit more lenient and I can put more, use other techniques. Does he want to go and use it to raise funds? Then I might be a bit more discerning about how I approach it. Either way, you need to put a value to those inferred resources. You can't ignore them. They do have value. And so let me just back check there. I need to understand, or if I was you, I would find out why he wants it. Because you can give him a blue sky value if you like. So that I like to stretch the envelope and tell my client that that's the art of the possible. But my friend, for the purposes that you want to use the valuation, this is an appropriate value that you must look at. You also need to qualify in both instances the things that can go wrong, the risk associated with that value. So let's put another thing. Let's say your measured resources were the big bulk, and you needed to mine for about 5 or 6 or 7 years only through inferred resources before you actually got a value. Well, the risk associated with those inferred resources are quite high. There's a lot of uncertainty about them. And how can you put a value to the actual measured stuff if the capital is all served by inferred resources to get there in the first instance? And another thing I must say is that each instance has its own unique set of circumstances. So when I get confused or uncertain about this, I go back to those principles of transparency and reasonableness. And then I elaborate clearly on why and what the situation is. So in your instances, the first thing I would do is go and put a discounted cash flow to that whole thing. I'd put a plan to it. However uncertain or high level it is, it's conceptual. I put a plan to that concept and I do a preliminary economic assessment. Then I'd say, all right, now I've got that value. And I've got a feel now, because you do get a good feel from that if you've applied your mind well. But now I need to actually put a proper value to it from a CV point of view, because I want to go now and raise funds. Then you've got to go and look at other valuation techniques. So I'd go and look at market comparables and look at what inferred, some of them similar type properties, what the inferred component carries as a value, what does the measured component carry as a value, or the indicated component. I'd look at the stage of operation. Maybe there's been sunk costs on the mine. And then I'd also look at the cost that has been spent to date. And then you as a CV needs to apply your mind and say, well, I'm putting that value down. If you have included a whole lot of inferred resources, then show them with and without the value. At the end of the day, you as a competent valuer need to pick a value, and you need to say, that's my opinion at this point. And as I said, I would give a value that's associated with the information that's come forward from using three methods to give me a balanced opinion. And then I would give my opinion on that. But there certainly would not be no value to the inferred. Remember, inferred resource you can't take to a reserve. But that doesn't mean you can't put a value to it. And indeed, you should put a value to it. You're required to. You're undermining the potential or the value of that property by not recognizing that value. Rodney, does that help you?
Yeah, no, thanks, it does. And I agree, you've got to give it a value. It's just that there's obviously uncertainty with that value. And,
no, of course, and just talk to that.
A range. So if the value was going to be made public, do you end up disclosing that range of values associated with that risk, or do you still have to just pin one number? Because it just seems almost unrealistic to pin one value number when you've got a large risk associated to it.
No, I think what you do is you report the range, but you must say that's my number. So as the CV, the independent competent valuator, you are taking a view on the value within a range. So it's very acceptable to say that this is the high end and that's the low end for that approach. For this other approach, that's the high end, that's the low end, and for this last approach, and you can use as many approaches as you want. The onus is on you to be aware of why am I doing this, who am I doing it for, and what is the end purpose. And that plays a material role as well. And it shouldn't change the value that you give, but it can talk to what you should be saying in your document so that there is transparency and clarity and independence and competency. All those things are very important.
Yeah, good. No, thanks.
Okay, sir.
Thanks, Rodney. Before we get back to the live questions, there's a couple of questions here from Carrie. We'll take one of these at a time. First question coming up, Vaughan, is the risk factors that you describe are largely qualitative. How do you relate them to a quantitative aspect such as revenue forecast?
All right, so let's say what would be a good one? You can use statistics, you can use Monte Carlo analysis, and a number of different tools that are mentioned there. I do have some pretty pictures here somewhere of how Monte Carlo works, but I don't want to go into all that, it'll take forever. There are qualitative techniques, like bell curves and statistics, where you can demonstrate the level of uncertainty around your assumed norm or your mean value. So if you assume a price of X as your mean, what is the uncertainty on either side of that? So, I might have only spoken about qualitative ones there, but there are a lot of quantitative assessments.
Vaughan, could I maybe give you some guidance on what I had intended there?
Yes.
So, for example, you're right, you could do statistics to get a forecast number, but let's say you're trying to understand the risk of a social situation or maybe legislative changes that are coming up.
My hearing here, I'm going to turn my volume down a bit because it sounds a bit tiny. I didn't hear you clearly there, sorry. Go again.
Okay, so I said you're correct in identifying that there are quantitative risk methods like statistics that you can use.
Yes.
But how do you relate that to a social aspect? Like, how would you make it equal if you were assessing a social risk or
A social risk? All right.
There's a high level of perception involved.
A social risk, that's fine. You can look at a qualitative approach where you would actually sit in a room with people who are maybe familiar, maybe you, the CV, you don't actually have a feeling for those social issues out on the mine. So talk to people that are actually working on the social labor planning, and ask them, what are the range of possibilities? Remember, whenever you try and put a weighting, if you like, to risk, you've got to be mindful of two things. The one is, what's the likelihood of this event happening? And if it happens, what is the consequence? What is the impact of it? So those are the things you're trying to weigh up all the time. It doesn't matter what type of risk you're looking at. That's what you're trying to weigh up. When you've got a feel for those two working together, that's the magnitude of the risk you're looking at. Yes, and it can be both quantitative and qualitative. Sometimes I use numbers to give me qualitative weighting. And how you do that, there's a technique called Kepner-Trejo, is an old technique. And there's so many of those also in the market. But they're a process you would work through by, I have a feeling from 1 to 10. What is my feeling from 1 to 10 on this aspect? What is the feeling from 1 to 10 on that aspect? I remember years ago actually looking at or doing this. It was a mine in the Free State. And I think it was SRK. They sent one of the S or the R or the K, I can't remember who it was, who came out to the mine and he said, all right, let's work through revenue. What are all the components of revenue? And then we didn't try and do statistical analysis there. All we did was look at a range of a range of possibilities for all the components. So, you actually had I don't know if you can see my hand, but like a decision tree that then broke into various portions, and then you can work backwards on the probabilistic of each one of them. And you've done the theory of probabilities, so you're just working backwards. And you do that for revenue and for costs, both capital and OPEX. So social, where would social come into? Social would come into the cost of ameliorating the problem. So in terms of valuations, only one or two things are going to happen. It's either going to cost me to sort that problem out, or it's a fatal flaw that's going to stop my work for some reason. And you need to have a feel on both of those. The fatal flaw, you might not go ahead. You might not have a value to it if it's a fatal flaw. But invariably, things can be dealt with on a cost basis. And that should feed back into your the costs that you've put into your valuation, so that you can then look at the potential impact. So if you take consideration of the risk and say my cost could move up by that much, you put it into your valuation and then it comes up with a totally different number. Well, now you're starting to, that's the potential loss I could make. That gives you a bit of a feel for the impact or the risk associated with that social problem. What would it cost me to appease those people? So it requires a bit of engagement with people knowledgeable about how to deal with communities for you to start putting value to that. Does that make a little bit of sense to you?
Yes, thank you.
Carrie,
Thanks.
if you and this goes to all of you guys, if there's something that's specific in your life that you are welcome to phone me at any stage. You've got my number, and I don't mind giving advice over the phone, if to be a bit more specific. This is a general platform, and sometimes you can't be specific on a general platform. Okay, next one.
Okay, and let's take one from Neil. Would you like to unmute yourself and ask your question, please, Neil?
I'll do that, thank you. Vaughan, thank you very much for the presentation. I did appreciate, I did enjoy it. Vaughan, I just want to ask a question, just to get back to your comment of earlier, what is the valuation for? Should it matter what the valuation is for? You know, I'm worried that we should never be concerned as valuators what the person is going to do with the number. We just give the best number, middle of the road number, no fanfare. And, you know, it's almost like asking a person to say, look, how much are you prepared to pay for the valuation? And then I will stand on my toes to match the price. And I'm worried that the use of the value may not be, shouldn't be important to what the valuator is trying to do, because what it encourages the client to do is to release the information to get the number that they want. So I'm just concerned that in going that way, where you start saying, I'm open to a discussion about what you're going to use it for, we should never let the client have the discretion of what they're going to release to us. But that was just a follow-up on your comment right at the beginning. My question was actually of this form. Should the geoscientist have any role to play in valuation as a lead in valuation or as a competent valuator? Because there's nothing in the geoscientist training, there's nothing in their training that actually equips them for this kind of thing, for valuation. Nothing in the curriculum. They can go and get training afterwards. They can do a BCom and they can do a BFinac, or whatever all those wonderful things are. But nothing in the geoscience curriculum anywhere in this country allows them, or probably equips them well enough to know this. So I'm thinking that there isn't enough training for geoscientists to go, and I put on another hat that is not a science practice actually, but is a practice of finance. So I'm just wondering if you have any thoughts on that, because then when you answer that, it ties up with the question that will come later. What should they then be trained in? I will stop now for the moment and give some other people a chance.
Neil, it's nice to talk to you again. I haven't forgotten you. How are you? Hi, Neil. All right, there were two parts to his question here. The one talks to wanting to know the reason for the valuation. I think the worst thing you can do is, if you're a competent valuator, you put your head in the sand and just come up with a report. I think you should empower yourself with knowledge as to what the commission entity wants to do with your valuation. Because that way you're positioned to disclose and reveal and explain to the public what you have done and why this has been done that way. And it's just good practice to inform yourself as to why and how. And then it goes to managing your client's expectations, so that, you know, there's one thing about being theoretical, Neil, there's another thing about actually doing the work. What you mustn't compromise on is the value itself. You must be able to hold two thoughts in your mind at the same time, be happy that you're aware why this guy wants it, but that's your value, my friend, that's your value. But if you understand what he wants it for and what the agenda is behind it, you can position your report correctly, you can frame it properly, and you can be fair to those who are reading it on both sides. And I think that's terribly important. Otherwise, we hide behind a mechanistic, I didn't know, sorry, it wasn't my fault type attitude. And I think it's incumbent upon us to make sure that what we're putting out there is used for the right purposes. That doesn't affect the valuation. The value is the value. Okay, and then when you talk about the competency, that's the geoscientist part. We're not talking about the competency of being, you're talking about the ability and having the competence to use the right methodologies and the right approaches, and also to know what you don't know, so that you can put a value or put a value to an entity.
Yes, that's what I'm asking.
I mentioned there that you need, one of the requirements in SAMVAL is that you are able to satisfy yourself first, that you will be able to defend what you have done to peers in the industry. When I say peers, these are not your geoscientist peers. They are other competent valuators. So if you don't have that comfort, then you need to go and get the training necessary to give you that comfort. So if that training talks to being able to do a discounted cash flow analysis, or use an option pricing, or to use some sort of probabilistic analysis, or whatever methodology you need, or if you've got to be an accountant to understand IFRS, you need to go and do the training applicable to all of that. You might find that by having spent years on an organization or a mine, Neil, that you've actually acquired a lot of knowledge, and you don't have a piece of paper, a certificate. And that's fine. You don't need the certificate. But you need to be able to demonstrate to your peers and yourself that you are competent. This may change in the future, but at the moment, that is the position. So a geoscientist, certainly he can be a competent CV, but when he's operating as a CV, he's not operating as a geoscientist. And he needs to make sure that otherwise he must stand back and not do the job. So just because you're a competent person doesn't make you a competent valuator.
Thank you, Vaughan. Thank you, Vaughan. I appreciate that. Thank you.
No problem. And again, I say hi.
Hi there. I'll catch up with you later.
But everybody, I know Neil from a past life.
Raymond, would you like to unmute yourself and ask your question, please?
All right, thanks, Tana. Then just, for me, I've got two questions. One is related to, I mean, you've got an asset where you've got a piece of ground where you've previously taken it out of the resources, for instance, due to RPAA. I mean, it could be a range of issues. And now you want to put that asset, or you want to evaluate that particular asset. What do you do with that piece of ground that you've previously declared as it's not a resource when it comes to valuation?
I'm not understanding you. You say you're taking the minerals out of the ground. Is that what you're saying?
Yeah, look, I mean, obviously.
So I can put a value to the minerals and I can put a value to the ground.
Well, when you publish mineral resources, they have to go through RPAA, right? So you have done an assessment and said, look, this particular piece of ground cannot be a resource. Example could be, well, I do not have, ventilation strategy to go and mine it because, virgin rock temperature is very high. So it's not a resource. You haven't published it as a resource.
No, but you mustn't get confused between a resource and a reserve. So a resource is something that's, you talk to eventual economic extraction. In other words, it just lies in the ground there. And eventually either the price changes or technology changes and there's a reasonable chance of that change happening, you can call it a resource. That's not a reserve, and you can put a value to a resource. A reserve is different. A reserve is, I've put a plan to it now, and that plan may require ventilation, as you say, and that has a cost and has other modifying factors that will now take what's in the ground and put it in the market. And all those costs associated with taking out of the ground and putting in the market you take cognizance of them in your evaluation methodology. So I'm not sure what you were asking there, but I just want you to differentiate between a resource and a reserve.
No. Look, I think I'm clear with the definition of the difference between a resource and a reserve.
Okay, so you wouldn't worry about ventilation with a resource. It's got nothing to do with it. Okay,
but fine. I mean, you have published a number to say for this particular asset. Let's say, for example, look, I've got 100 million ounces in the ground of a resource,
Mm-hmm.
right? But there's a ground that is not included in there because
So
you have
the actual
decided
value of the land. You're saying the value of the land.
not the value of the land, the mineral resource that you have now published is less than a particular ground where you have taken a decision and say, I'm not gonna publish this thing as a resource, either because I do not have, I don't know, geological confidence in it. I don't have enough information, or the ground is too complicated for me to declare that as a resource. But that particular ground still belongs to you as the owner of that property.
Yeah, and you haven't even got it. So what you're saying is not even in the inferred category. So
Yes, it's not in the, it is in the inferred category, but you took it out. You have decided, no, I'm not going to publish it as a resource.
well, why would you decide to do that? I mean, that's a choice you make.
Yes.
So why would you want to do that? If you must have had a reason for taking it out. So why are you asking me what would you do?
That's why I'm going back to RPEE, because you have decided that, look, based on the current technology that I have, right, I cannot go in there and mine that particular ground.
No, but
Jump in to help with this. I think what Raymond is talking about is stuff which is, it's still in exploration potential, it's still an exploration target, because if it doesn't have RPEE, Raymond, it cannot be considered an inferred resource. So it would be pre-resource. Is that what you're talking about?
Yes, it's a okay, let's call it a pre-resource.
oh, you said it was inferred. Oh, okay. Yeah.
Okay, I'm also going to suggest that we leave this discussion for a little bit later. Maybe you can take this offline, because this is going to be a very long but very interesting discussion, but we need to move on. And our next speaker is Andy McDonald, and Andy's going to talk to us about the valuation methods and approaches. Now, while I introduce Andy, can you start sharing your screen with your presentation, please?
So, Tanya, how do I share my presentation with the screen now?
Down at the bottom, there's a green block that says share screen.
Right, got it.
Click on that.
Yep.
Then select your presentation.
Okay, so I must have the presentation open on my side. That's fine. I'll do that.
Vaughan, you can switch your screen, your video off, please.
I just want to say something, Tanya. That gent that I was talking to now, you're welcome
Yes.
to give him my number and he can phone me and I'll talk to him offline.
Okay, we'll do that. Okay, so you got your presentation up and running, Andy?
I've just got to find it now.
Okay.
Where's it gone? Sorry, I can't see it on my screen. That's crazy.
Maybe you've minimized it. Doesn't matter, leave it minimized. Go to share screen.
Okay, that's there. All right, share screen. Yeah.
Select your presentation.
I'm not seeing it popping up in my, well, okay, let's just go screen. No, it's not doing it. This is very strange. Where on earth are you now? Let me just try again.
Okay, open up PowerPoint, get your presentation running.
Yeah, okay, it's on.
Okay, now try the
Try
share screen.
again.
Do you see it there?
There we go.
Okay,
There we
and then
go.
down the bottom to the right-hand side, there we go. All right, now get your presentation running. Yes, click there. Okay, right. Now, Andy MacDonald is has been doing mineral asset valuations for more than 20 years. He's a principal engineer with SRK Consulting, specializing in due diligence audits, competent persons, and mineral asset valuation reports and engineering studies. He's a registered chartered engineer through the Institution of Materials, Minerals and Mining in London. He's also a fellow of the SAIMM, holds a BSc in Applied Maths, an MSc in Geophysics from the University of the Witwatersrand, and an MBL from UNISA. He has over 46 years experience in a range of activities in mining and light industrial industries. He has served on the SAMVAL working group for the past 10 years and is currently the Vice Chairman of the SAMCODES Standards Committee. So Andy, we look forward to you talking to us about practical aspects of valuation. Thank you.
Thanks, Tanya. Good morning, everybody. So let's get straight into this. So you would have seen earlier, Vaughan was showing a whole range of different valuation methods. So I'm going to be going through the cost approach, the market approach, and the income approach. But from the first two in some fair detail, then the income approach, then some of what I call there the uses and abuses of DCF and valuation. So to look at the cost and market approach, I've selected an early stage alluvial diamond exploration property in the Middle Orange River, which looks like this. So this is the property I've selected here arbitrarily, but you can see all these little crosses are all operating or historic mines, where you can see what they have mined, the values that they've got out of the stones, the grades, etc. So based on being in the right street address, this property, little over one here, highlighted in yellow, should have good prospects for hosting diamond-bearing gravels. Now, I must say that this does not imply that it does hold the gravels, but it's just to be used for illustration. So we're talking about a property of 4,800 hectares on the Middle Orange River, and we can expect 2 gravel terraces to be present. So you would have seen the slide earlier with Vaughan. So because we had an early stage exploration property, the income approach is not applicable to value this property, but the market and cost approach, as you see at the bottom down here, are what are the appropriate approaches to be used. So in terms of the cost approach, you've got the multiple of exploration expenditure, or the prospectivity enhancement multiplier, as it's called. There's probabilistic methods that we'll look at too. There's the Kilburn Geoscience method, and then the option farm-in joint venture approach. And then on the market approach, I'm going to look at comparable transactions and highest and best use. Now, all of these terms are what Vaughan showed earlier. So let's just have a look here and see what is the cost approach. Now, a critical thing with the cost approach is that the cost must be relevant. And what is now relevant cost? So for example, if you've got a prospect that you've been busy working on for some time, and your chief executive officer comes to do a courtesy visit with some marketing people, and that costs R1 million to bring them all there, that doesn't actually add to the scientific knowledge of the property, and therefore is not a relevant cost in terms of the cost approach. So the prospectivity enhancement multiplier, all it is it's a range of numbers from typically 0 to 5, so that depending on the results of the exploration that you've undertaken and the costs you've incurred, you can then multiply the cost by this factor to then determine a value for the property. So in the case you've done some work and you've not found anything, then you would apply probably a 0 to that cost on the basis that the property has no value. If you've then intersected what you're looking for, you could then apply a value greater than 1, which then enhances the value of the property relative to the cost that you've spent. So let's take an example here of an expiration budget for this little property. We're going to go through 4 stages of doing target delineation, which would hopefully then we'd do some work to intersect gravels. We then do some sampling and we can confirm that the gravels are diamondiferous. And then we can do further analyses and valuation of the diamond parcel to say we have an economic grade and value. So that there would be over a 3-year period. And on a simple basis, if you take those cash flows, you then say, well, in first year, I would guaranteed spend 100%. The second year, I might spend less, so 90%. And year 3, lesser again, so I apply an 80% probability. The NPV of those 3 adjusted expenditures then comes to 9.7 million rand. And because I'm fairly confident where the property is located, and I'm now optimistic, I'm going to apply a prospectivity enhancement multiplier of 2 to that, say, I believe that after having spent that 13 million rand, the value of the property would be 19 million rand. Now, Vaughan mentioned it's always necessary to determine a range around your preferred value. So in this instance, if I take a prospectivity multiplier of 1, so it's neutral, or 3, so very optimistic, that would give me a potential range around my selected value. Now, the probabilistic approach, this is the one method put together by Norman Locke and Andre van der Merwe in 2007. So what you're doing is you're now assigning probabilities to the different stages, as you can see in the middle here. So you have a preferred, a low, and a high for the success, the probability that a given step would be successful. So target delineation on that west bank of the Orange River to find gravels, well, it's likely to be very successful, that I should find targets there. That I actually intersect gravels, well, I expect that, but I've got a low and a high. And so I go through, apply these different probabilities for each stage. Those probabilities get multiplied by the expenditure base and then just added up together. And so this gives me now a range of 9.5 to 26 million rand with a value of 20 million rand as the value probability value for this under this method. We then look at a different probabilistic approach, and this looks quite complicated. So it's all premised on what is going to be the target value at the end of our whole process. So exploration goes through a whole series of phases, and eventually you get to a feasibility, which would be the pinnacle of the triangle, and that is now the target value. So what do I expect to get out of my exploration over time is I would expect to develop or prove up 20 million cubic meters of gravel with a grade of 0.7 carats per 100 cubic meters and a diamond value of $2,000 per carat. So that's our exploration premise, to say once we spent the 12 million rand, that's what we would have proved up. So applying now the diamond yardstick factors of 2 to 4.5%. So you would recall Vaughan talking about a gross in situ value. So if you take the total gravel resource times the grade times the value, that's a gross in situ value which you cannot use to value a resource. In this instance, you apply these heavy discounts, 2 to 4.5%, to those numbers, and then you get a range of 72 to 163 million. But that is now at the conclusion of all the work. So now we need to determine what is the value that we are sitting with as we are at step A down here at reconnaissance exploration. So this is how it works. So here are the two values, 72 and 163, as developed from the yardstick method as the target value. And these are the probabilities of moving from each level from A to B, B to C, and C to D. So 0.8, 0.5, 0.5, and again here. So it gets quite complicated, but so we take, according to the formula, we take the target value times the probability less the expenditure, and that gives us the value at D, the expected value. Then we take the next one, so we take 30.7 times the probability of 0.5 less 3.1, and that gives us 12.2 at C, at the end conclusion of C, and doing it again. So then we apply 0.8 on 12.2 less 3.4 gives us a 6.4. So that's mechanistically how it's done. So applying these parameters onto these yardstick values, we then get a probability of the expected value at A, down here at reconnaissance exploration, between 6 and 24 million rand. I'm going through this quite quickly, and we can take a discussion afterwards, but this is just to show you the processes involved. Then we have the Kilburn Geoscience method. It has this grid, which talks about, let me just move that out the way. So it has these 4 factors: off-property factor, on-property factor, anomaly factor, and geological factor, and then various ratings down the side here. And so you need to then select internally here parameters that relate to your property. Now, I have adjusted the terminology in here to suit the diamond project. If you were working with an iron property or a gold property, the values in here would have to change. So in the Kilburn Geoscience method, there's 3 aspects that they want. You need a base acquisition cost, a prospectivity factor, and then that gives you, then they apply it into a formula. So the base acquisition cost here, all I've taken is the first year of expenditure for the next 12 months, so that then the 3.36 million rand becomes 700 rand per hectare. And looking at these parameters, I've said that we should have favorable lithology over at least 50% of the lease. There are no targets outlined, so that's anomaly factor. There's no known mineralization on the property, but we expect it to be there. And then if you take the mines in the area, you've produced at least 20,000 carats per year from those neighboring mines. So applying these parameters, so we've got 3.5 times 1 times 1 times 0.9 gives us a factor of, there's the numbers there, gives us 3.15 times these, the 700 rand per hectare times the 4,800 rand hectares, gives us a potential value of 10 million rand. There's a couple of problems with this method because it's highly sensitive in terms of the base acquisition cost that you select. And the when you're applying these parameters, you're applying it to the entire license area, which in many instances is not geologically correct. So you could be overstating the value in this instance by virtue of taking the entire property size. But having said that, so if we've got a value of 10 million rand, set a range at plus or minus 50% around that arbitrarily at this stage to have a preferred value and a range on this particular method. Why are you frozen? There we go. Okay, so another common situation that we encounter is what they call an option or a farm-in arrangement. So in the event of someone having a property and I'm now interested in getting involved in that property, I enter into an agreement with them whereby there's certain payments that are made up front for a shareholding in the project. And then on completion of certain stages through the exploration, I would incur the cost to do the exploration, but in the process, earn an additional shareholding in the property. So you can see here, apart from the million rand up front, here's the expiration budget that we'd put down, which is the 12 million rand. So by the time I've spent 12 million rand plus the 1 million rand up front, so 13 million rand, I could have earned up to a 49% interest in the project. Okay, so here we go. So here's the expenditures. We're applying a, let me just get this right, yeah. So we've got probabilities of success at each stage, 0.8, 0.1. These are the same probabilities we applied previously. And applying those to the expenditure, giving these lower and higher discount, the lower probability, the higher probability of that number. So 3360 times 0.8 or times 1, etc., etc. Applying the discount factors here, then I get lower or higher discounted values at each stage. And then this gives me the totals here. So I'm looking at a figure of between 11 and 14 million rand for the 49% interest that I've gained, which then means the entire project value is between 23 and 28 million rand. And I've just taken an average at this stage for reference purposes. So those are all the cost approaches for the moment, and we'll come back to them in a second, well, a few minutes time. So now if we look at some comparable transactions, so this becomes now a market-related approach, and the comparable sales method relies on the principle of substitution, whereby you're using transactions of similar properties in the area to get a metric, whether rand per ton, rand per carat, rand per hectare, that you can then apply to the property in question. Now, there's a whole number of things here when they talk about comparable. So similar geology, similar size, mineralization, grade, location, mining method, logistics, infrastructure, and stage of development. Now, bear this last one in mind, and we'll come back to that a little later. So if we look at these properties here, here's the different properties: Saxon Drift, Nieuwejaar Scroll, Rich Drift, Woterspoon, etc. The year in which the transaction took place, the size of the property, how much was spent for to acquire an interest in the property, some of them 100%, some 50%. And that then converts into a price per hectare at the time of the transaction. Now, here we've got different periods, 2001 to 2007. So during that time, the value of the properties or the value of those assets could change quite considerably. So it's necessary to get them onto a common date period. And that's what the purpose of getting to an adjusted price is over here. And then from these statistics, I've taken the median, which is the not the average, it's the most frequently occurring number that sits in the distribution, and then the low and the high. And applying the adjusted values to the area, so this 1, 12, and 28, I then get application median, low, and high adjusted rand per hectare prices. I get potential value for the property of 60 million in the range of 7 to 138. Quite a lot higher than what we've seen previously, but again, we'll talk about that shortly. Then if we talk about highest and best use, Vaughan mentioned this earlier as well, and there's 5 considerations where you have to consider to say, is this a viable method to use? So physically possible, appropriately justified, legally permissible, financially feasible, and results in the highest value for the property being valued. So here are a number of properties that I had identified in the vicinity of our target property. And so you can see the size of the property in hectares, the asking price for those different properties on the property website, which then converts into a rand per hectare over here on the right-hand side. And because those were at the date when I was doing the evaluation, they are current values, so I don't have to do any adjustments to those. So again, I pull out a median, a low and a high. Applying that to the area of the property gives me a potential Habu value of 25 million in the range of 22 to 116 million. Okay, we've spoken a lot of numbers. How does this all stack up? So if we look at this now, you'll see here the different methods that we've looked at down the left-hand side: cost approach, the two probabilistic approaches, the Kilburn method, option JV formula method, the market comparables, and the highest and best use. And here are the numbers presented in terms of the minimum, the midpoint or the preferred value we pulled out, and the maximum in each case. And if you then have a look down here, if we exclude the market comparable and the highest and best used value, I then get a figure here of 20 million rand in the range of 9 to 25. Now you would ask, why do I exclude the market and the Habu valuation? Let's look at this graph on the right-hand side. And this is always something that I advocate when you've got a range of values that you've derived, to get a sense of where these all stack up. So if you look at all the cost approaches, and let me get my cursor here, you can see that these are all in the same sort of area, but the market comparable is very different, and so is the Habu very different. Now let's just talk about the market comparable in the first instance. That was derived from operating mines. So to use a rand per hectare value on operating mines is probably not appropriate, but certainly those properties are in a stage of development very different from the property that we're looking at, which is an early stage exploration property. So from that perspective, a market comparable here is not relevant to the target property and should then be discounted or ignored in this case. In the case of the highest and best use, which is this bottom one down here, those properties in fact were all game farms. And so this is suggesting that you'd have a better option of using this property as a game farm than going to mine it at this stage. So notwithstanding, excuse me, all of this, if we just take these 5 cost approach methods, what we've ended up with is a value of, at the time that we spent the 12 million rand on this property, we could expect, well, right now we have a value for the property of 20 million rand between 9 and 25. So that's how that has then come together. So now I want to go on to the income approach, and here I'm going to be, I'm quite sure that everybody has done some form of cash flow analysis, built up models in Excel, etc. There are various good and bad techniques to be used there, but I'm not going to dwell on that now. I wanted to focus on the considerations that underlie the parameters that go into a cash flow model and the results that come out of it, because this is where your opinion that you then have to draw at the end in terms of the value that applying becomes quite important. So let's just look at now an estimate of tonnage and grade that's been built into a resource model on which a mine plan is being developed. So you've got a whole string of boreholes that have been drilled. So you've got a 50 millimeter piece of core, which is up to 100 to 200 meters apart. The geologists have interpreted geological continuity, and now we have a resource model that we can then go and work with. Now, the problem is that invariably you have variability in your grades, but on average, they are consistent, and hence the locally imprecise, globally precise. So when you now say, I'm going to mine that ton of ground, to say that the grade is 3.16 grams per ton, you can't say that with absolute certainty. But if you said, I'm going to mine 1 million tons this year and I'll get 3.16 grams per ton, you've got a good chance that you would be very close to that. The next thing is that the metallurgical test work, the metallurgists will always tell you, and the laboratories will always tell you, it's on the basis that the sample being tested is representative of the whole ore body. Now, in many instances, you get variability in your metallurgical parameters, and sometimes these actually have to be factored into the resource model that you take those into account. Also, but on the basis of the drill hole information, you then would have interpreted structural complexities for which you then apply your geotechnical designs for the open pit or the underground layouts, etc. But again, those are interpreted from the drill hole database or seismics or aeromagnetics or whatever. But those generally pick up the macro features. Now, a fault of just 2 meters in a 1.5 meter seam can give you a lot of headaches in terms of where do you go once you intersect it. Then think about the production schedule that the mine design is now developed. Often it's using a standard or assumed development mining rates. Sometimes these are overly aggressive, and in many instances they're also not achieved because of a variety of reasons, such as they are based on identified structural disturbances. In many instances, this is more complex than what we anticipate. In some instances, the parameters are based on the original equipment manufacturer, supplier, equipment efficiencies and costs, and those may be achieved initially when the equipment is new, but with time it doesn't happen. And again, depending on the nature underground and the mining conditions, could also impact on the extent to which those are achieved. Then we also, in terms of building up production schedules, you assume standard labor productivities, and those are not always achieved either. Then the next one is the estimates of the capital cost. Now, over the last 10 to 15 years, there's probably been half a dozen articles that have been presented showing the extent to which projects do not get implemented on time and within budget. And in many instances, the overruns on capital can be 30, 40, 50% above what was originally stated. Similarly, the estimates of operating costs for the mine, we develop the costs in today's terms, but we don't know what's going to happen going forward in terms of electricity price increases, labor cost increases, the cost of diesel, other consumables, etc. So any projections going forward could be quite widely wrong. Now, this is probably the biggest one. So we complete a feasibility study, which is nominally at a level of, I quote, unquote, accuracy of 10%. I mean, that's the recognized industry standard for a feasibility study. So you might be able to engineer your capital and operating costs to that level. You might have high confidence in your resource, your production schedule, and the rest of it. But when you do the economic evaluation, a big input is your price forecast. If you use, in North America, they are very keen to use the 3-year trailing average. And in fact, in some instances, they actually specify that you have to use it. Now you can see there in a rising market, if you take a 3-year average price, you would be understating the price in relative to the point at which you're doing the valuation. In a falling market, you actually overstate the price, which then makes it look better than it actually is. If you now say, well, let's get some metal price forecasts from financial institutions, consensus economics, or anything of the like, this graph just shows a comparison of forecasts in 2008 against what the price actually did subsequent to that. So you can see the forecasts are these are the forecast lines here, this lot here, this lot here, this lot here. And in most instances, the forecast prices were very different to what actually happened. So now we have a look at the prices. Well, okay, these are a bit old, but are the prices now static going forward? So metal price forecasting is always a little bit of an art, and there's no guarantee that the prices going forward are going to be achieved. Now, in constructing a cash flow model, there's some other uncertainties that we have to consider. So if you build a real terms model, in other words, all your input parameters are stated in today's money and kept in today's money for the life of mine. That has the problem of tending to understate the tax obligation. If you now say, right, okay, let's get the tax right, we're going to build a nominal terms model. Well, now you've got to apply inflation indices to your operating cost, labor, power, diesel, consumables. And nobody knows how those are going to escalate going forward. So you would now assume certain rates, you apply those, and in fact, what you're doing is you're introducing more uncertainty into the evaluation. So I would argue that if you do a nominal terms model, you cannot then say it's to a feasibility study level of confidence, because you've increased the range of uncertainty in the model. If you want metal price forecast in nominal terms, you then got to apply the differential of the CPI rates for the states, United States and South Africa, because most commodities are priced in dollars. Then we need to get a discount rate. Now, just to select a discount rate of 8 or 9 or 10% is all very well, but is the weighted average cost of capital, or the capital asset pricing model, where you can develop a discount rate for a particular company, but it requires certain parameters to go into deriving that discount. And one of the big problems often is finding a suitable proxy company to get the beta, which has to go into the equation. And sometimes, what is the appropriate debt equity ratio that has to be applied to the particular company? So some of the problems that I've often encountered in looking at models is you see nominal metal prices, but you've got real or mixed operating costs. So you're not having all your parameters on a consistent basis. The next one is a very common situation where you get, let's say you get your metal price forecast from Consensus Economics. They don't give you any indication of exchange rate forecasts. So if you get an exchange rate forecast from Bloomberg and a metal price forecast from Consensus Economics, they're coming from different sources and may not be directly comparable. Then your capital costs, operating costs, and macroeconomic forecasts are stated at different effective dates. So my capital costs were developed in December 2019. My operating costs are in March 2020, and the economic forecasts were done in May 2020. Now those parameters are all at different time bases, and that presents a potential problem. Then I've got, in amongst my capital costs, I have costs that are foreign denominated currencies, and they've been converted by the contributors to the study using different exchange rates. So somebody's used 16 Rand to the dollar, somebody's used 18 Rand to the dollar, and somebody else has used 19 Rand to the dollar. So now those capital components are not comparable. Then in the case of a feasibility study now, but where you're doing a due diligence audit on an operating mine, and you look at the forecast production and operating costs that they are presenting, and you see material changes relative to what's been done in the past. The question is, well, how are they going to achieve those? So if they're looking to go suddenly do 5 million tons a year and they've never done more than 3, well, how are they going to get there? Have they put capital in to increase the production? What have they done to the plant, etc., to cater for that? So those are very important considerations to where you see material changes in forecasts. And often you see this one too, is people will advocate, well, I've got a very risky project, so therefore I must increase the discount rate to cater for the risk. Now, you'd be actually better off to identify what those risk components are and try and engineer the risk out by suitable capital expenditure, and then apply the appropriate discount rate to that. Now, with all these things that I have raised now, with all the concerns, the issues, the bases, and the assumptions that underlie all of this, you still see revenues and costs in the DCF model calculated to the nearest cent. Now, in case of reporting of resources and reserves, we are required to round the numbers off to show the level of confidence. So you never see a resource being quoted as to the nearest ton. It would be maybe reported to thousands of tons or even millions of tons to the 1 decimal point. Now, why then should a revenue and a cost be presented to the nearest cent? Rather present them as millions of rands or even thousands of rands if you have to. But certainly the same principle should apply in a DCF model as to the underlying resource reserve classifications. And then the best of all is the NPV at the discount rates is now reported as an absolute number which gets written in stone and becomes inviolate and can never be changed. So this Ms. Somerville in 2015 put this down to say that a sensitivity analysis should always be done using a range that matches the annual price volatility of the commodity across a number of market cycles. Now, prior to 2008, the global economic crisis, prices were generally quite stable. So looking at a plus or minus 10% sensitivity or even 20% around your metal price was reasonable. But since then, we've seen huge volatility with spikes and troughs. So since from 2010 to 2016, you could probably argue, or for 2008 to 2016, you could probably argue that your price sensitivity should be as much as plus or minus 50%. Now, you put a minus 50% sensitivity on most projects and it would go, the NPV would go negative. So that has a quite significant impact on reporting of results. This is what we consider also from the SAMVAL working group is best practice in terms of reporting of NPVs, is to show the sensitivity of the NPVs in twin tables, such as this one here, or revenue versus OPEX, or similar. In this instance, what I'm showing here is that in the middle, the 479 would have been the value at the selected long-term price and exchange rate, which would have been $45 a pound at 15 Rand to the dollar. At the time when we did this work, though, the price was $22.50 and the exchange rate was 13 Rand 50 to the dollar. Now all of a sudden that goes negative instead of being positive. So it's one of the requirements of IAS 13, which is to use parameters that are readily recognizable, such as spot values, as a sensitivity in presenting results. Now, we had a bit of a discussion earlier on regarding of inferred resources, and Vaughan did talk about this. So, as you mentioned, the importance is where do these inferred resources sit in terms of your life of mine plan? Now, if they are heavily skewed to the front end of the project, then you have a material risk which needs to be addressed. Otherwise, well, you wouldn't even base a mine plan on an inferred resource in the first couple of years. Second thing is materiality. Is it a smaller percentage spread over the life of mine? Is it greater than 10%? I have seen some where you've had 20, 30%, even 40% over most of the life of mine of inferred material, which presents a problem. Now, the minute you've got inferred material in a life of mine plan, which happens, sometimes you've got to mine through an inferred block to get to a measured block. You then we are obligated to alert the user of the report or the model that the inferred resources have been included in the cash flow analysis. And this is where the JSE in particular says, well, then we should report the NPV with and without the inferred resources. So if you exclude the inferred resources and the revenue that comes from that, but you still include everything else, what does that do to the net present value for the project? Okay, so then the last thing I'm going to just touch on is some aspects regarding comparable transactions. And invariably, when you go and select these from a source, they would be over a different time period. So if we have a look at this now, these are some transactions for some coal properties. And you can see these vary from October 2008 to September 2012. Now, if you look at this graph here, which is the RB1 export price for coal from Richards Bay over this time period. So October 2008 is pretty much at the peak here at $163 a ton, whereas September 2012 is down here at about $86 a ton. Excuse me. So if you'd sold the property at this point in October 2008, where you got these high coal prices, the value ascribed to that property would be higher than if you're selling it when the price is lower down here at $60 or $86. So hence, we need to we can't just take the base values as paid for them and work from that, because you then not using the numbers are not strictly comparable. One of the ways to get around this is you convert the dollar per ton, in this instance here, to the price ruling at the date of the transaction, and as a percentage. So then these percentages here would be relevant if you apply them to today's coal price. The alternative is to say, okay, I want to take these parameters and apply an adjustment factor to bring them to today's date. And then excuse me, I get these adjusted amounts on the right-hand side here. And then taking the minimum, medium, and maximum values out of that. So I've got a range of percentages I can apply to the current coal price, or I've got dollars per ton that I can apply to the coal resources. Now, Andre van der Merwe, in a previous valuation colloquium, had presented these two graphs that he used to convert, get an adjustment factor for a copper transaction. So the one was the copper price, and the other one was the NASDAQ small cap mining index. And so based on this here, from moving from 8.5 to 6,000, he developed a ratio of 0.7, and then a factor here of 0.33. He averaged those and said, right, so whatever I had in 2012, and I wanted now in 2016, I need to apply a factor of about 0.5 to whatever the valuation was then. It could also be argued that maybe this should be used as the ranges, the upper and lower limits of that adjustment, and then just to get an alternative view on how things have moved. The importance for specifying the valuation date, again, as Vaughan mentioned earlier, it's something we have to say the valuation is correct at an effective date, because a day or two later, things could have changed and the value is then no longer relevant. So consider these two valuations that were done in Q1 2012 and Q2 2018. And you can see there's a considerable difference in here purely because of the movement on the underlying metal prices, metal and coal prices. And that's my number.
Thank you very much, Andy. Okay, folks, we'll take questions. We've still got a couple of minutes. Anybody'd like to raise their hand? Like you've totally confused everybody, Andy, or otherwise they completely understand it.
Let's hope it's the latter.
Like to unmute? Neil, go ahead.
Hi, Andy.
Yeah, go ahead.
Thank you. Andy, could I just ask very quickly, man, you mentioned all the fact that your valuation is good for a point in time. Now, having gone through this entire exercise of doing a valuation and giving the client an answer, that's the valuation and it's correct on the 1st of January. When a new valuation is done, would it help that the valuator says that in future, client, when you redo the valuation, the important drivers of this valuation is exchange rate and, for example, product price. So only check those ones. Don't go back to square one and do a whole new valuation a year from now. But the valuation report drafted that says it's correct on 1st January of this year says, look, this is the drivers. So only change these, only go and reinvestigate these two variables and report on that and update accordingly. Just your thoughts on that. Thank you.
Okay, Neil. Well, a couple of things. So if you now fast forward a year and you've got different metal prices now, you would actually need to consider to what extent that has changed your calculation of your cutoff grades that you've applied to your resource and reserve calculations, which in turn could change the reserve declaration and what tonnage you have available for your life of mine plan. Secondly, because you're now 6 months or a year further down the track, your components of your operating costs could have changed. And even you may have got to a point where some of your capital budgets have not been spent or suddenly realize that they are under budgeted and need to be adjusted. So you can't just say, I'm going to just change the metal price and exchange rate forecast. You need to reconsider all the aspects that go into that financial model.
Thank you.
Thank you, Andy.
Did you want to add on to that, Neil?
No, ma'am, I just wanted to say thank you.
Okay, thanks. Peter, would you like to unmute yourself and ask your question?
Thank you, Tanya. Thank you, Andy. Andy, I come from the other industry, the oil industry, oil and gas. And I noticed in a lot of your valuations, you talk about the product price of the day. In the oil and gas, each company or each organization has got a forecast for the next 5-10 years, how they see the price develop. And they do their economics based on the production per year of the price of what they expect in that year. So you don't get that big volatility because quite often these product prices, the oil and gas prices, are lower or are assumed in their forecast to be more stable than they in reality are because they're an average over the whole period, as you also said in your presentation. Is in the mining industry really that you work with the price of the day to do your valuation going forward, or do you also use an average going forward for the next 5 to 10 years?
Yeah, Peter, what we generally would use is we would get metal price forecasts from an industry expert. So if you're doing ferrochrome, it would be Heinz Parisa or UBS, I think it is. No, anyway, and then if you're looking at some of the more common commodities, your PGMs, gold, copper, nickel, you can get that from Consensus Economics as an example. You can also, there's got Steve Forrest and Associate who does the projections on platinum, palladium, and rhodium. So we would generally try and get some metal price forecast that we would use in the cash flow analyses going forward. So that would be, because we as competent valuators, well, I certainly don't consider myself competent to assess projected or metal price forecast or exchange rate forecast for that matter. So by getting it from an industry recognized source, Consensus Economics, Bloomberg, etc., we put that into the cash flow model and then say, well, there's the NPV based on that metal price forecast. All we're doing by using the spot values at the date of the valuation is to say, if we apply this, this is what it does to the cash flows as purely as a comparison as part of sensitivities. And it's also one of those, what they call it, observable inputs in terms of IAS 13, one of your international accounting standards. So that's where the recommendation comes from, is purely just from a sensitivity point of view that we reference back to spot values.
Any other questions? Do we have any other questions here? Okay, well, thank you very much, Andy. We have a couple of minutes break before we continue on with our next presentation. So rush off and get your muffins out of the oven, get your coffee off the cupboard. And while you're doing that, I'm going to launch another poll. If you would please fill that in the meantime. And feel free to chat and ask questions until we start again. Keegan, would you like to unmute yourself and ask your question, please?
Sorry, thanks, Tanya. It was meant to as a bit of a tongue-in-cheek comment, but how often, or has anyone got experience in whether the Habu principle or value for a specific project has been, the determining factor in whether to invest in a project or not? I'm just curious as to example, because in the industry sort of that I'm working in, we're talking about 25 to $35 million valuations. Now that's basically a small spa in a larger metropolitan area. If you have to compare the two projects. So does anyone have sort of like an example that they can share where they've used that principle and that it has cost the project to invest or not to invest?
Andy, do you have any comment on the Habu principle?
No, Tanya, I've actually not used it in normal practice. So I can't comment on it at all.
Vaughan, yourself? Vaughan? Out getting coffee. Okay, has everybody voted? I'm going to close the voting in a couple of seconds. It's interesting to see where all of our delegates come from, which commodities. Looks like we have a very nice spread throughout most of the commodities. Okay. Peter, are you ready to continue or to go on?
Yes, Tanya, I will share the screen.
Okay, share your screen and your video on, please.
Let me see, screen one. I think I can do this one. Can you see the screen now?
There we go. Let me just introduce you. Peter Dekker has been or studied marine geology at the Free University in Amsterdam, and he is an accomplished veteran explorer and conference speaker. His professional career started with Shell International in the UK on both the North Sea and the West of Shetland exploration. After 6 years in the UK, Peter moved to the Middle East, to Oman, where he gained experience as a production geoscientist as head of the Sambal Geoscience team. In 2001, Peter joined Prospectivity Energy, which subsequently was taken over by Gaz de France as chief geologist. In 2004, he moved to global exploration manager in Paris, after which he came to settle in South Africa as exploration manager for Africa. Since 2013, he has been working for Petro SA as chief geophysicist and has served as an advisor for E&P portfolio rationalization projects. Peter is also the chairperson of the SAMOG committee. And so, Peter, we look forward to hearing from you further on your the SAMOG code, and then there'll be a pause, and we'll move into the production or the valuation methods after that. Thank you.
Okay, thank you, Tanya. I think it's all one big presentation. So if you want to have a pause, just pause me somewhere in, because I haven't really done it in the order as you put it there. I would first wanted to give a little bit of the background and then just go into the SAMOG itself. Is that okay with you?
That's fine, Peter, no problem. I'll
Okay,
give you a break after about half an hour. Let me see. Yeah, at 11:45, we'll break for a few questions, if you don't mind, and then we'll
That's
continue.
fine. Yeah, I will see if there's a natural break, and then I will ask questions in between. That's fine.
That's perfect. Go ahead.
Okay, thank you. Very good morning, everyone. As you heard from Tanya, I've got quite some experience in oil and gas and very limited in minerals, other minerals. But I think it's quite important that the two different industries can learn a lot from each other. So in essence, here there's the reporting codes. How does the petroleum industry report on hydrocarbon quantities and value globally and in South Africa? Let me see if I just, there we go. This is a general disclaimer we use in the industry that all the material opinions expressed are mine and not necessarily from my employer. So you just quickly go through it. I'm first going to describe a little bit about the oil and gas industry. I assume that a lot of you don't really know what it is, of how the details of it and how it is organized. Then I will talk about some of the stakeholders, sharing of information, reporting, resource management, petroleum resource management systems, and then oil industry and the security exchange, and then the SAMCODES in the end. But first to set the scene, lies, damn lies and reserves. That is a book written in 2005-6, I think, by Ian Cummings. It's about the shell shock, the secret and spin of an oil giant. In essence here, the first page, you can read it already. On the first sighting of an iceberg was made in London on the early hours of Friday, 9th of January 2004. And then in the yellow part, in a tortured language made baffling opaque by jargon, the company appeared to be saying that it had, as though in a fit of absence of mind, overstated its reserves by nearly 4 billion barrels, 3.9 billion barrels. So that was in January 2004, and suddenly Shell informed the industry and all the shareholders that, sorry guys, we overstated our reserves by more than 4 billion barrels. Yeah, here the other yellow part. Given that most industry analysis value oil companies on the basis of their proven reserves, and I will explain later what proven reserves is. It was a profoundly shocking message. So in your proven reserves, you suddenly reduce it by 4 billion barrels. And at the time, I think the barrel was something like $50, $60 a barrel. So you can see what the company had overstated and had to reduce on their value. That's enormous. Now, where does it come from? If you now look here, this is just a report which came out yesterday by McKinsey. And it really shows now with the drop in the oil price, what happens to the economics of the produced oil. So at $25 per barrel, at least 2.5 million barrels a day of the global production becomes uneconomic. And you can see that in the middle here, this is $25 a barrel. You see that 2.5 million barrels a day of production becomes uneconomic. And if it is sustained on that level, you really will have to stop the production because you're losing more money than you're getting. At $30, it's only 500,000 barrels per day. But you see, if you go down to $20 a barrel, you go up to 6.5 million barrels per day of about the 80 million barrels a day produced, which become uneconomic. So it's just setting the scene a little bit. So oil and gas industry in general. The global oil and gas value chain is made up of three sections. They're called the upstream, the midstream, and the downstream. The upstream is really the hydrocarbon exploration, field development, extraction, production of hydrocarbons, and then, of course, afterwards, the abandonment of the infrastructure. It is the most complex and most risky part of the entire value chain. And potentially the most rewarding if you get it right. Yeah, it's depending on the oil price and on your success rates. The average success rate, and we'll come to that later, in the oil and gas industry is for each exploration well drilled is about 20%. So 1 in 5 wells is successful, 4 in 5 wells is not successful. The midstream is really hydrocarbons are processed, stored and transported. That's the link between production and public. And then the downstream is really products are manufactured and sold. Now these two things, the mid and the downstream, quite often overlap. And we are only going to focus at the moment on the upstream part. So it's the global oil and gas value chain is really the upstream part of it. So upstream E&P companies conduct activities relating to searching for, developing and producing of hydrocarbons. It is all about drilling wells and building infrastructure. Where should you locate the well? Yeah, how to design and construct, operate and manage the wells and the infrastructure. And it's all aimed at deliver the greatest possible return on investment with the lightest, safest and smallest operational footprint. Now on the right hand side you see two different platforms. One is a floating platform, the top one, and the other one is a standing platform on the seabed. Both can be used for production, but often the top one is used mainly for drilling of the wells, exploration, appraisal or development. And the bottom one is quite often used for production only because it's fixed once it's there. Oil and gas resources are the most important economic asset of an oil company. And here I clearly say resources because later you will see there's a huge difference between resources and reserves. Yeah. Financial strength depends on the amount and quality of the resources you've got, you're entitled to. Resources are the source of the future cash flow inflows and provide the basis for borrowing and raising equity finance. So in principle, you will later see that reserves are more important than resources in our definitions, but sometimes you want to value resources as well because that's the upside you get. Business characteristics of the upstream industry, it's very capital intensive. Just to give you an indication, you might have heard that Total, the big oil company, has just got a rig into South Africa to drill on the south coast, offshore Mossel Bay. Last year they drilled one well there, which was an exploration well, and they were lucky. They found some gas. They had hoped on oil, but they found some gas. And this one well, just to drill, not even knowing if it's commercial or not, had costed them $150 million. Not rent, $1 million. Just one well. Now they're down here for 3 more wells, and they really talk about $350 to $400 million investment without even thinking of knowing if it's going to be commercial, what they're going to find. There's no certainty yet because gas is not as profitable as oil is. And at the very deep water, we talk about 1,500 meters of water depth. And then you drill another 1,500, 2,000 meters into the rock underneath. So it requires a long-term commitment. As I said, they started with this project about 8 years ago. They only drilled a successful well last year. They're going to drill a few more wells this year, and they expect another 8 years before they get the first gas flowing. So you talk about something 10 to 15 years between starting on a project and your first cash inflow from your production. So it's a long-term commitment. Technologically very demanding. This offshore where they're drilling at the moment is really one of the roughest places on earth where they're drilling. And it has a high commercial and technical risk. But if you get it right, with high returns. There is a high uncertainty in the asset resource quantities and value. And I will show that later a little bit, but you never exactly know how much is there until you really close the field and walk away. It requires a lot of specialist employees, both in technology and in project management. Can you imagine a project of 40 days drilling in very horrific offshore waters? You need some very good project managers to keep this on track and within budget and within time. Further, it's very highly regulated, mainly in HSE, resource quantification and financial reporting. And as we all know, like in the minerals, it's impacted by global politics and the oil price and the gas price rising up and down. Oil prices more than gas prices. To give you an idea, in 2015, the oil market was bigger than the entire raw metal markets combined. The oil market was $1,720 billion. And you can see here the gold was only 170 billion, iron was 115 billion, aluminum was 90 billion. So the oil market was really much bigger than all the metals together. That's in 2015, and that gives you a scale from how we look at it. The industry players profile. In the oil and gas market, you've got super majors. In essence, there are only 5 super major oil companies. One is Royal Dutch Shell, ExxonMobil, BP, Chevron, and Total. Then you've got major international oil companies, medium-sized independents, small-sized independents, and national oil companies. To name a few, BG Group, Maersk Oil, OMV, ConocoPhillips, Wintershall, you see them. And then the national oil companies, you've got Petrobras, Equinor, Petronas. Yeah, and the majority of the hydrocarbons are owned by the NOCs, so control more than 90% of the proven oil and gas reserves. And that's, of course, as you can expect, mainly in the Middle East. And then, of course, you've got the service companies, the engineering consulting firms, and the independent consultants. Now, the main service companies are Schlumberger, Halliburton, CGG, just to name a few. So the exploration and production in the oil and gas industry is a misunderstood business. This is a very nice book. It's issued by the AAPG, that's the American Association of Petroleum Geologists. And one of the quotes in there from John Lawrence was, when one transfers X barrels of oil from an inventory perceived to hold capital X barrels of undiscovered oil, there is no requirement that the remaining undiscovered oil inventory is capital X minus X barrels. We never exactly know how much there is in the underground. Until the moment that you have closed the field, you know what you've been able to get out economically. The qualities of the E&P inventories are unique and are not ordinary. Like a can of beans, you buy a can of bean and you know that most of the beans taste the same. Yeah, you get a whole tray of beans, 24 cans of beans on a tray, and each can will taste the same. In the quality of the inventory in the oil and gas industry, not a single field is the same, not a single gas composition is the same, not a single oil composition is the same. And you really have to, everyone has got its own way of looking at it. It's the same with the size. Unlike normal inventories, E&P inventories can not ever be counted or audited. Only estimates can be given. So we really doing a lot with uncertainty estimates. And that's what I noticed in minerals. You were much more sticking to fixed numbers instead of really the uncertainties in your reserves as well. And I hope to demonstrate to most of you how we do it in the oil and gas business. And maybe we can learn from each other how we approach this. When the unique nature of the E&P inventories are not recognized and the general business practice paradigms are applied, the outcomes can be very problematic and can cause serious errors and can make companies go bankrupt. Yeah? The cost of finding and developing reserves is not directly related to the amount of reserves you find. I'm sure that's the same in the mining industry. So in South Africa, like the minerals, it's at the moment still governed by the MPRDA from 2002. However, we must have heard that there is a new petroleum bill being designed at the moment. We hope that it's going to be promulgated by early next year, the first quarter next year, which will be the Upstream Petroleum Resource Development Bill. And but there will be similar things in this bill as the MPRDA. So I will only discuss a little bit of the MPRDA today, and it relates to petroleum resources. The concessions gives 4 different concessions. It's reconnaissance permit, technical cooperating permit, an exploration right, or a production right. Yeah. In the bill, there are onshore and offshore permits and rights covering conventional and unconventional petroleum resources, I will later highlight the difference between conventional and unconventional. The NPRDA makes provision for state and broad-based Black economic empowerment participation in development projects. So in the exploration phase, there is no state participation or no Black economic empowerment participation needed at this moment in time. The new UPRDA will have the state participation in the BEE participation already in the exploration phase. But at the moment, it's only in the development phase of the projects. The exploration production rights in South Africa. On this map, you can see the rights. In South Africa, we've got IOCs, Shell, Total, and ENI are in South Africa. We've got NOCs, PetroSA, and Qatar Petroleum are in South Africa. Mid-sized companies, Sasol, CNRL, Equinor, and small-sized Sunbird, Africa Energy, Molopo, startup BEE companies, and service companies. On the map on the right-hand side, you'll see all the green areas are exploration rights or production rights. All the brown areas are rights under application. So you can see mainly the offshore is covered, and there are quite some rights onshore as well. So what are we talking about? The business is about sustainable reserve development and profits, of course. We won't do it without profit. Identify hydrocarbon potential and secure funding for commercial, sustainable exploration, appraisal, development, production, and don't forget the abandonment, the restoration back to original state. Why do we evaluate and classify resources? The first is to communicate. Yeah, we want to communicate the potentially available quantities of oil and gas. Yeah, how much is there? How much do we think is there? Resource chance of recovery. Yeah, how much would we be able to get out of the ground if we can get it out at all? Yeah, so it's the chance of recovery. Then the uncertainty estimates, yeah, of resources. Yeah, we give a number, but it's very unlikely we will get that one number out of the ground. Yeah, it will always be more or it will be less, and I will demonstrate how we in the oil industry do that. And then the timing when these resources will be available for the market to consume. And then, of course, the commercial viability of the resources. Yeah, it's all done to make a technical, economic, and financial political decisions which are required to obtain and manage continuous supply of hydrocarbons for the country, for the world, and for our industries. So what do we evaluate? Conventional oil and gas resources are what we call API oil types. That is normal oil, which really comes from a standard reservoir. So it's a sandstone or a carbonate reservoir with porosity, where the oil will flow from itself or with a little bit of help to the surface. And the natural gas or natural gas liquids, which come to the surface as well. The API stands for American Petroleum Institute, because they have defined the oil gravity. So some oil is very light oil, which you can just put in the tank of your car to drive on it. But other oils are very heavy oil, and they need waxy oils. So every oil type is different, and the API gives a type of oil you have found. Then you've got the unconventional oil and gas, and mainly oil, and that is low mobility, permeability oil and gas. So that is really, like you heard, the shale gas, the shale oil, the bitumen, very heavy oil, the oil sands in Canada. Gulf methane, the oil we try to get out of the coal seams. And then kerogenous shales, underground coal gasification, methane hydrates, and since a couple of years in South Africa, we also have got helium, although that's not an hydrocarbon. It's a byproduct from hydrocarbons quite often, and that comes to the surface, but it's very valuable. So these are the gases and the oils we evaluate. So who are the users of these evaluations and of these reports? Now, the stakeholders of the industry are the E&P companies themselves. and they use it for business processes. So it's the IOCs, the international oil companies, the national oil companies like Petros A, small and independent oil companies. They use it for their own strategic planning, their own planning going forward, their budgets, when do they need it, and their cash flows. Yeah. Then, of course, the contractors, service companies, suppliers, and consultants. They're looking for where do we need to provide services, which country will have the biggest, newest exploration phases going on or development phases. Then, of course, you've got the governments, which have to regulate the resources and the resource management and energy studies. The International Energy Agencies, the United States Geological Survey, they really look and see from how much energy do we still have got in our own country. Do we have to import oil and gas, or can we live from the oil and gas found in our own countries? And they make their strategic plans for the country and for the governments going forward. Then you've got the financial sector, the security regulators, standard committees, investors, and banks. Obviously, for investing, for investors, and for loans, bank loans, they need all this information. Then you got the consumers, the midstream and the downstream. Can we build refineries here? Where would we get the oil and the gas from for the refineries? Is there enough for our clients? And research institutions, skill development, technology, universities. Do we really have to train geologists for oil and gas? Or do we only train geologists for minerals? And then last but not least, is the general public and the NGOs, environmental organizations and affected parties. They also need to know what's there, how much oil and gas is there going to be found, and what can we expect to come. So all these reports, how are they used? Now the corporate and business processes is really investment and operational decisions. Resource management functions is plan and administer the optimal use of government-owned natural resources. Yeah, the laws always state that all the natural resources in the country belong to the people of the country, although the IOCs and other oil companies who take it out of the ground get the right to take it out, but the government gets royalties or get their own share of it, and they get all the taxes as well. General energy studies is really identify and make decisions on future resource activities. And then the financial reporting, I've already spoke about it, raise funds for oil and gas activities and provide information to investors to enable them to make investment decisions. So what are public reports at the stock exchange? A public report is really important to inform investors on the company's financial status. For example, annual and quarterly company reports, press releases, information memoranda, technical papers, websites, and presentations. They include regulatory required reports as well. So every oil company has to report to the agency of twice a year on what they're doing, and they are reports required by the regulatory agency. Cover any document which may find its way into public domain, and refers not only to reporting by companies listed on the security exchange, but also includes reports compiled by private companies or individuals. So these are all public reports. So what do all these reports have in common? They either report on quantity or volume reporting, petroleum resource assessments. I put here quantity or volume because in some jurisdictions you have to report oil in tonnage, so it's not in volume, but in most jurisdictions you report in volume. You report either in barrels or in cubic meters of gas or cubic feet of gas. But in some jurisdictions you have to report in tonnage, and that's then the weight of oil. That's why I put quantity volume reporting. They deal with the quantities of hydrocarbons found. They deal with the uncertainty of these quantities, and they deal with the probability of recovering these quantities of hydrocarbons, because it's not sure how much we can recover from the subsurface. Then we've got value reporting. These reports deal with the cost of developing and producing the hydrocarbons. They deal with the expected product price, and they deal with the net present value and cash flows of the product. over the years to come. So these are the two different reportings we use, and they're quite often intermingled in the oil and gas industry. So resource quantity versus value reporting. Although they're very closely linked, there are some differences there. Resource quantity reporting follows either the petroleum resource management system, and I'm going to show you later how the system works. Value estimated are included in this PRMS system. So you have to have an idea about value, but it is on a lesser system than really in value reporting. There's another system called Canadian Oil and Gas Evaluation Handbook that's mainly used in Canada, and also there they use value included in the system. Other systems like Chinese, Russians, or United Nations systems, and I'm not going to talk about these systems, but there are various systems used in the world. The most used system is, however, the PRMS, so the Petroleum Resource Management System. Classifies subdivide quantities depending on the chance of commerciality. Yeah, so we talk about reserves, contingent resources, or prospective resources. And I'm going to clearly show what the difference is. But these three main categories are the chance of commerciality. So the prospective resource has got the least chance of commerciality, and reserves should be commercial. And then you've got categories to show the uncertainty in each of these classes. Yeah, so we really deal with uncertainty in the same resource reporting. Then we come to value reporting. And value reporting is either done via the SAMOG code, that's mainly in South Africa, or the National Instrument 51101, that's mainly in Canada, or regulations SX and SK, like in the United States, or any international recognized standard acceptable under the CIM or SPE, that's the London Stock Exchange. Now the SPE is mainly under PRMS, and then there's another value reporting system called IMVAL, and I know that minerals are also being able to be reported under IMVAL, but IMVAL also covers oil and gas reporting. So reserves as input of valuation assessment and futures net revenue. So in oil and gas, most of the valuations are done on reserves only. You can put a value on resources, but if you report on resources, you have to very clearly demonstrate the risk and the uncertainty related to resources that you might not be able to recover it from the subsurface. Because resources, by definition, are not sure you can recover it yet. It takes into account timing, production, and market assumptions. And that's what my question was earlier. The market assumptions, we have to very clearly state there. What is your oil price forecast? What's your gas price forecast? What is your CPI forecast? And what is your exchange rate forecast? Valuation versus evaluation. Valuation is really the estimation of the value of mineral properties in money or monetary equivalent. In the US, they use the word appraisal. It is the basis of value is market value, fair value, or investment value, or whatever value you have got in your own company. Evaluation is much broader. It's a broad physical, legal, economic, and other assessments of mineral properties, which are needed for investment decisions. Evaluation includes feasibility studies, pre-feasibility studies, scoping studies, and is really strategic assessments. Yeah, both make use of quantity reporting, and that's really how much resources are there. So that is really the volume or the quantity. Both make use of value reporting as well. Quantity reporting requires evaluation along prescribed guidelines, and I will give you these prescribed guidelines from the PRMS very soon. Here we come. The Petroleum Resource Management System. The PRMS is a framework for classifying and categorizing estimates of all petroleum reserves and resources. PRMS provides an industry consensus on basic principles and high-level guidelines. that, if adopted, will improve assessment consistency between different countries, between different companies, and helps companies to manage their business. PRMS is not written as a public disclosure rules. Issuers should continue to comply with regulatory requirements for external reporting. PRMS is not a textbook on detailed evaluation techniques. And that's the biggest difference between the PRMS and the COGI, which is the Canadian system. The Canadian system, the COGI, is really much more prescriptive. PRMS leaves much more open to the resource evaluator to interpret it and justify why he does it in certain ways. PRMS strategy is really to allow flexibility and can be tailored to her needs. The PRMS really thinks about the geology is not everywhere the same. You cannot really prescribe how you should treat geology because every project will have its own little issue you have to deal with. It does not modify the interpretation or application of an existing regulatory reporting requirements. It only helps it. Yeah? It considers both technical and commercial factors that impact the project feasibility, its productive life, and it's related to cash flows. So cash flow is important there, but it helps you to identify the cash flow in the project. It supports asset management from cradle to grave. So really from exploration, generate your prospects up to the end, the decline and abandonment. You go through the whole system. So the major principles of the PRMS is it's project-based. And I will explain later what project means, what a project exactly is. The classification is based on the chart of commerciality, as I stated earlier, and we really distinguish between classes, so the classification, and the categorization, which is the uncertainty in recovery. How much would you be able to get out of the ground? The base case uses the best estimate quantities recoverable under the evaluator's forecast of future conditions. So we determine the future conditions, we mention the future conditions, and then what can we get out of these future conditions, or what can we get out of the ground? Provides granularity for project management, and it estimates based on deterministic and or probabilistic methods. In recent years, we much more go towards the probabilistic methods, especially in exploration and appraisal. Once you come to production, there is still quite a lot of deterministic methods used, but you can already see in production that more and more evaluators start using probabilistic methods to calculate the volumes in place. It applies both to conventional and unconventional resources. Reserves and resources are estimated in terms of sales products. Yeah, so what can you sell? And it's the first point of sale where you sell it and what you can get for it. Net resources are allocated based on the contractual entitlement. So if you've got entitlement for 20 years production, you might have resources there which can last for 30 years or 40 years production, but you're only entitled for 20 years, so you can only calculate the 20 years value of your product. A project under the PRMS is defined as an activity or set of activities which provide the link between the petroleum accumulations, resource subclass, and the decision maker's process, so the budgets. So in essence, in a project, you need to have a certain amount of money available to do activities. If you don't have this money available, you cannot call it a project. So you have to have money available for the project. A project may, for example, constitute the development of a single reservoir or an increment development of a large producing field, or even multiple smaller developments or a group of fields next to each other. Yeah, with a common ownership or shared ownership. In general, an individual project will represent a specific maturity level, subclass, at which a decision is made on whether or not to proceed. So, for example, one of the subclasses is prospects. Yeah, am I going to drill this prospect? I don't know if hydrocarbons are there or not. The project is to drill the prospect. And that's a subclass of it, and I need to have budget for it, and I've got an idea from how much I will get out of it. there should be an associated range of estimate recoverable resources for that project. So even for my prospect I drill, I must have done my evaluation to understand if this is successful, if I develop it, how much would I get out of it? And this is an estimated recoverable resources, and will be in a whole range. It will be a low, mid, and high range from what I can get out of this prospect. Reporting under the PRMS refers to reporting of hydrocarbon reserves and resource quantities and their uncertainty within the business entity conducting the evaluation. Although we use value to identify whether something is a reserve or a resource, we don't report on the value itself per se. We report on the quantities we get out. It is left for the reporting to the stock exchange to give the value there. But we should have a feeling for the value. It should not be construed as replacing guidelines for subsequent public disclosures and the guidelines established by either the regulator or the government agencies or any current or future associated accounting standards. So the petroleum resource management is really telling you how many barrels of million cubic feet we can recover from the underground. And to know what's reserves or whether it's resources depends whether it's economic or not economic. And for that, we need to have the value. So here we go from what we talk about petroleum resource management system. In the underground, you've got the total petroleum initial in place. We call it PIIP, or hydrocarbons initial in place, which can be HIIP. That's the total hydrocarbons in the subsurface. This total hydrocarbons in the subsurface can be divided in two parts. One is the discovered petroleum initial in place, and the other part is the undiscovered petroleum initial in place. So you've got certain areas which are discovered, where you have drilled and you know it's there. And you've got certain areas where you have not drilled yet and you've got no idea whether it's there or not. It's still very risky to drill it. Then the discovered hydrocarbons initial in place can be subdivided into commercial or not commercial, not yet commercial. And I will later explain to you what commercial will mean. So the discovered is commercial, not commercial. The undiscovered you don't subdivide further. By definition, the undiscovered is not commercial. So the commercial, you of course got the produced hydrocarbons. That's the hydrocarbons you've already taken out of the ground. Then you've got the reserves. Reserves by definition have to be commercial. Then in the not commercial and the undiscovered we call resources. So if you talk about hydrocarbon resources, it can either be not commercial discovered or it can be undiscovered hydrocarbons, what you can, in place. Now in here, the resources can be divided into contingent resources. The contingent resources is the share of the in-place hydrocarbons which you think you can get out of the ground, which are discovered. So there's always a share of it which is unrecoverable, which will always remain in the ground. And then the prospective resources is the share of the undiscovered resources which you think you can get out of the ground. And there's always a big share of unrecoverable prospective resources, which is just called unrecoverable resources. So the prospective resources and the contingent resources by definition is what you can recover from the underground, so what you can get up to the surface. Now the reserves can be divided again in between reserves on production, so which are still producing at the moment, approved for development, which are not developed yet but are approved for development, and justified for development. That means they might not be approved yet, they are very close to approval, but they are justified to be developed. Then contingent resources can be subdivided in development pending, development on hold, development unclarified, or development not viable. So the development not viable clearly is sub-economic, and the other three classes are expected to become economic with more work. And then the prospective resources are subdivided into prospects, needs, and place. So they are called classes. That's called classification. So in essence, from the bottom going up to the top, you get more maturity. The bottom ones are least mature, and you've got the least chance of really recovering hydrocarbons. And the more you go to the top, the bigger the chances that you can recover the hydrocarbons. That's what you see here: increasing project maturity, decreasing commercial uncertainty. Now then we come to the category. And the categories is really the horizontal axis, and that's the technical uncertainty. On the left is the least uncertain, and to the right is the most uncertain. And how we do that is we put in numbers there. So in the reserves, you've got the proven reserves, which we call the P1. Yeah, and that's the proven reserves. And the 1P and the P1 should be the same number in this case. And in essence, what it means is you're for 90% sure that you will get this amount of reserves out of the ground or more. And then you've got the probable reserves, the P2, and the 2P is the proven plus the probable reserves. So these, in essence, are you're for 50% sure you're going to get this amount of reserves out of the ground or more of it. Yeah, so if you talk about 2P reserves, so maybe your 1P reserve might be 10 million barrels. So I'm for 90% sure I'm going to produce 10 million barrels or more. The 2P reserves is maybe 50 million barrels. I'm for 50% sure I'm going to produce 50 million barrels or more. And then you've got the 3P reserves, which is the 1P of the P1, the proven, the P2 probable, and the P3 possible added together is the 3P reserves. And that is where you're for 10% sure you're going to get this amount out of the ground or more. And that might be, for example, 100 million barrels. So my 1P 10, my 2P 50, my 3P 100 million barrels gives you the uncertainty, the geological or whatever uncertainty that you get these amount of hydrocarbons out of the ground. They're all reserves. You all know there's a chance for they're all commercial to get out of the ground, but there's the uncertainty whether you will get it out of the ground. And the same accounts for the contingent resources, but then we don't call them P's, then we call them C's. So there you've got the 1C, 2C, and 3C. Again, the 90%, 50%, 10% chance, or the C1, C2, C3. And then the last one is, of course, the prospective resources, which is 1U, 2U, 3U, or the P90, P50, P10. And that's for prospects and leads. So that's how we work with it in the oil and gas industry. So we never give one number for what is in the subsurface. We always give all three numbers. Net cash flow based evaluation, it's entities net cash flow. Yeah, it is limited by the period of economic interest or reasonable certainty of renewal. Yeah, may be defined differently by entity, company, or regulatory environment. So if you've got a 20-year production right, you can only take the 20 years of production into account unless you've got a very reasonable security that it will be extended by another 10 years. And that's open to the evaluators to understand whether that's the case or not. Utilizes forecast production, cost, and schedules, and applies a set of defined conditions. May either be a constant case, so current economic conditions, but you have to state its current economic conditions if they are used for the forecast, or it's a forecasted case where you tell what the forecasted case for you is, but you cannot use both, or you cannot mix it. It's either current or it is forecasted. The entity's net resources are defined by the earliest truncation of technical, license, economic limits. So once you've reached this, then the resources stop. Undeveloped projects' cumulative net cash flow as of a given date must exceed the ARD liability. So the ARD liabilities are abandonment, decommissioning, and restoration. So you have got liabilities, and it has to exceed, the cash flow has to exceed these liabilities. And that's given in the graph on the left. You can see the black line is the cumulative production you've made. And then these bars are the cash flow, how it goes. And the orange bar is the ADR liability you get. And the red-orange line is the cumulative net cash flow. And you can see that the ARD liability doesn't bring the net cash flow below zero. Therefore, this is a positive project. Therefore, this can have reserves. What you're producing here are called reserves. So what's the difference between economic and commercial? Economic is positive NPV at a selected hurdle discount rate. A project is considered to be economic if its best estimate case has the positive net present value under the organization's standard discount rate, or if at least it has a positive undiscounted net cash flow. Here they use the best estimate. Quite often in oil and gas, we use the 2P reserves to calculate our economics. Not the 1P, but the 2P. So a 50% chance to produce that amount or more is what we use to calculate our economics. And if that is positive, then the project is economic. A project is commercial if it is economic and has got no contingencies that prevent production and sale. And later I will show you what contingencies there might be. But the project can only be commercial if it is economic and there are no contingencies. Reserves must be commercial. Resources can be economic, but still have got contingencies. So resources still have contingencies, which might be satisfied by conducting a project, an additional project. Resources can be economic or sub-economic at the time of reporting. So examples of contingencies, there are technical contingencies. So it can be technology which is under development. Then you will have to determine economic viability of the technology and determine the technical viability of the technology. So it's economic and technical viability. Will this technology be available at the time that I develop my resources? So it is contingent on this new technology. One very nice example is now on the south coast where Total is drilling. Yeah, 20 years ago, the drilling rigs were not suitable enough to drill offshore in these horrific mid-ocean conditions. At the time, Sucor tried it and the drilling rig was swept away by currents and by the waves. Now the drilling rigs are much more robust and have got much more propulsion to stay in position, and they are able to drill it. So the technology is now allowed to drill there. So these prospective resources became contingent resources last year when Total made a discovery there. And now they're trying to upgrade the contingent resources into reserves by drilling more places to see if they can make it further economic and that they can take all the contingencies away. So there can be economic status. Economics not meeting ranking criteria at this moment. So the contingency is that it's not meeting economic criteria yet. No project approved for maturity. Sub-economic at the moment, requires price or production increase to become economic, or it's undetermined. Economic status has not been clarified yet. These are still contingencies. Or it can be non-technical ones or non-commercial ones. Can be legal, regulatory approvals, access to markets, political, social licenses. All these things can be still contingencies why resources cannot become reserves. Okay, Tanya, I think this is a very, let me see. Let me go here. Qualified reserve evaluators and qualified reserve auditors are in the PRMS defined as two different reserve evaluators auditors. The first one has got a minimum of 5 years practice experience, and the auditor has got a minimum of 10 years evaluation and experience. The work they do is more or less the same, but they just keep a different definition for somebody with 5 years or somebody with 10 years. Either they have to have a college degree and be recognized degree, or they have to have enough experience in evaluating or auditing reserve and resources. Yeah, and they have to be a certified professional engineer, or geologist, and licensed. licensed geologists. And that's where you have to be a member of uncertified organizations, for example, like the American Association of Petroleum Geologists or the SPEE. There are various organizations, worldwide organizations, where you can qualify as a certified professional engineer or geoscientist. Then, of course, this is a nice quote, and after this quote I will stop. But once you've internalized the concept that you cannot prove anything in absolute terms, life becomes the more about odds, chances, and trade-offs. And that is really where we are working with in the oil and gas. We don't want to give one number, we give a range of numbers with the probability to exceed that number. And I think, Tanya, I've spoken quite a lot now. It's now 11:45. Maybe it's some time for some questions, if people have got questions.
Okay, anybody got any question? Peter, you can grab yourself a cup of coffee in the meantime.
I've got a glass of water. Here we go.
Okay, good stuff. Are there any questions for Peter at this stage from anyone?
Can you hear me, Tanya?
Yes, Neil, go ahead.
I was wondering, I've spent a lot of time in the unconventional gas industry in South Africa. Coal bed methane investigations, shale gas, and also the development of helium and simultaneously methane in the Free State. Do you think there's any chance at all that South Africa might get it right and develop some of these projects commercially?
I think that the gas in the Free State, this methane gas there with the associated helium, has got a very good chance of developing it properly, economically and commercially, because of the value of the methane. The issue is really that the gas on its own, with the infrastructure you need there, and the flow rate of the gas, made it marginally economic, also for the price you could get for it, to work. All the other projects, really it's the infrastructure which is lacking at the moment where this gas has been found. So the coal bed methane, when I worked for Sasol, we tried several things, and it was really, you could get it out, but the volumes were not big enough for the cost of the development. So it's all there. So we've got a lot of contingent resources there, but the contingency is still to make them economic and to get the infrastructure in place. You will notice that once the infrastructure is there, that the subsequent developments have become much cheaper. So these are really areas where we have to find from, can we do a joint development as a group together to make the infrastructure much less expensive per project. That is really for the gas as found in the Virginia area and in the coal bed methane area. For the shale gas has not been proven yet. That is still prospective resources at the moment. And there we still have to go through the prospective area, and that's where they're doing a little bit of drilling at the moment to see what is the shale potential, and does it make sense to drill exploration wells to go further. So that's really in the very early stage. But the indications the companies had was in the beginning very positive, but some companies have decided that the risks are too high and they can't make it economic, and they are planning to leave, although other companies are still very positive about it. So shale gas, I think there's still a chance, and PetroSA is also looking into that very much, but it's still a risky thing. The helium and the gas coming out in the Free State from the helium from the mining there, that has got really economic potential at the moment, also because of the helium price, which helps a lot. The coal bed methane, I'm not too sure.
Thanks very much, Peter. That's interesting. Thank you.
Anybody else?
I know it was a lot in a short period of time, but I hope it was a little bit clear, and the different way how we do it, that we really talk about the low, the mid, and the high in a certain way. And
I know every time I hear it, I understand a little bit more, but it's still going to take me a while to wrap my head around reporting stuff that doesn't exist yet. Thank you, Peter. Okay, if you'd like to, if you're ready, and then we can.
I'm ready to continue.
Okay, go ahead.
Okay, oil industry and the security exchanges. So petroleum industry and security exchanges. Listings. The IOCs are often listed in their own country of origin. Sometimes they're even listed in a second country if it is required. For example, Shell is was originally listed in the Netherlands, and then it got listed in the Netherlands and in London. And I know, for example, you see later, Sasol is also listed in South Africa and in New York. So the NOCs are very rarely listed on exchanges. I know one NOC, which is the old Statoil, now it's called Equinor. I forgot the name, Equinor. They were the national oil company of Norway, and they became listed at the Norwegian first because of they needed to raise money when they stepped out as an NOC. Most mid-sized companies are listed in their country of origin, like Sasol, but Sasol is also listed in the JSE, as I said. Small-sized companies might be listed in an area of operations or privately owned, and might not list to, might want to list to raise capital, and that's what we look in the JSE for. That if more oil and gas will be found in South Africa, that the small-sized companies would like to raise capital and would list on the JSE. Startups and BEEs companies might list in the to raise some capital. BEEs in South Africa might not list immediately from the beginning because they might want to have their own money first, and it's very hard to get a BEE listed to raise capital, although it might be needed, unless they're carried by the international oil companies. The state will be carried. So why the SAMCODES? It is really attracting finance is critical for projects in the petroleum industry. The petroleum industry is incredibly expensive. As I said, drilling one well offshore will cost you $150 million. And that's only drilling the well. To develop offshore, it's going to cost you billions of dollars. As you might know, the gas discovery is made in Mozambique, in the northern part of Mozambique, where Total is developing an LNG at the moment. That whole project is more than $4 billion. So you will have to raise money by either listing or getting finance from either bank loans or reserve-based financing. Access private equity is one of the other options available. Yeah? Public reports are essentially for investors to make decisions on their investments. The SAMOG Code in 2015 set out the minimum standards and requirements for reporting on the valuations of petroleum reserves and resources. The SAMCODES Standard Committee oversees these codes and the complaints procedure. So the SAMCODES Standard Committee, now we all know about it, is develops, maintains, ensures compliance with and promotes the South African codes. The joint patrons of the SAMCODES Standard Committee are the SAIMM and the GSSA. The SSC has broad representation from professional societies and parastatals. So the SAMOG Committee. This committee is set up to look after the SAMOG Code and ensure it is in line with the JSE and international standards and guidelines. This committee is a subcommittee of the SAMCODES Standard Committee. So the international guidelines is really the PRMS, as I tried to explain to you guys. The committee members are both local and international experts who have been involved in resource and reserve estimation and valuation. So as you can hear, I live locally here, but I am coming from the Netherlands originally. We've got a member from working for Sasol but living in the UK. We've got another member working for Sasol but living in Maputo. So it is local and international specialists. The committee works very closely together with the Alberta Security Commission and have used their reporting guidelines, the NI 51101, as guidelines to design the SAMOG Committee. So there's a lot of things which are similar to the NI 51101, but adapted a little bit more to South Africa after consultation. Since petroleum quantity evaluation by the qualified reserve evaluator is of essence for the petroleum industry. Misleading reporting and valuations in the past have devastating consequences for major companies. As I demonstrated to you, Shell had huge devastating things because it was misreporting on stuff. Trust in the industry, and the trust in the industry. The company oversees and recognizes professional organized organizations. So the we as a committee, we have really approved various international organizations in the oil and gas, because in South Africa there are no real oil and gas organizations. The GSSA has got oil and gas members, but it's not really dealing a lot with oil and gas standards. But the American Association of Petroleum Geologists is doing that. And SPE, the SPEE, all these organizations are really dealing with oil and gas legislation, how to evaluate. And that's why we recognize them as RPOs. The SAMOG code, this is the page. What is the SAMOG code like? Okay, reporting under the SAMOG code. The SAMOG code provides basis for minimum disclosure. You are always allowed to disclose more than what is in the SAMOG code, but that's really for the minimum, for public reporting on oil and gas reserves and resource volume and value. Public reports mean all reports prepared for the purpose of informing investors, potential investors, and their advisors, include but not limited to company annual reports, quarterly reports, all kinds of other reports, JSE circulars, company act requirements, environmental statements, information memorandum, expert reports, technical papers, website postings, or public presentations. Everything they report there in reserves or resources or value must be based, if they say it's based on the SAMOG, then it has to have a certain minimum level. The code applies to reports made on behalf of reporting entities to the public, and in other circumstances in which the reporting entity knows or ought reasonably to know that the disclosure is or will become public knowledge. Yeah, so if they report under SAMOG, then they have to apply the standards as stated in the SAMOG code report if it becomes public knowledge. So what are oil and gas activities? Oil and gas activities is the search for product types in the natural location. Acquisition of property rights for the purpose of exploring for or removing of hydrocarbon types from the natural location. Activities necessary to remove product types from the natural location, construction, drilling, production, etc. And production of synthetic crude oil and synthetic gas. So these are oil and gas activities. So all oil and gas activities fall under the SAMOG code. It's not included is activities that occur after the first point of sale. These are not included in the SAMOG code. Activities relating to the extraction of natural resources other than product types and their byproducts. And I will later demonstrate to you what the product types are. The extraction of hydrocarbons as a consequence of extraction of geothermal steam. Sometimes if you find geothermal stream, some hydrocarbons come together with the geothermal stream. These are not included under SAMOG code. So the product types we talk about is light, medium, and heavy crude oil, bitumen, natural gas liquids, synthetic crude oil, and other conventional oil. Synthetic crude oil is really the crude oil like in the oil sands in Canada. We don't have them here, but we still cover them under our SAMOG code. Yeah, these are the liquids we deal with. Natural gas liquids can be condensate, so that is gas in the subsurface. By producing the gas from the subsurface, bringing it to the surface, the gas condenses and gives a very light liquid, and that is the oil. In respect of gaseous hydrocarbons, we talk about conventional natural gas, unconventional natural gas, coal bed methane, shale gas, gas hydrates as well, and synthetic gas. Synthetic gas is really the gas generated by processes on coal or other hydrocarbon-bearing layers rather in situ. So like the gas, how do you call it again? The gas burning, underground gas burning, The gas released by that is called synthetic gas. Further application of the SAMOG code, as we heard earlier in the valuations, the code says it has to be material. Applies to things which is material to the company reporting. Information is material if it would be likely to influence the decision of a reasonable investor to buy, hold, or sell a security of the reporting entity. Transparent. Under the code, a report has to provide sufficient information in a clear and unambiguous way and may not mislead the reader. And competency. Under the code, a report is based on is based on work that is the responsibility of a suitable, qualified, experienced person who is subject to an enforceable professional code of ethics. So it has to be material, it has to be transparent, and it has to be written by a competent person. Oil and gas reserve resource evaluation that will be disclosed must be prepared by a qualified reserve evaluator. You will see that we are using a different terminology than in the minerals. We talk about the QREs, qualified reserve evaluators. And then you will see that the qualified reserve evaluator in the oil and gas industry has to be registered as professional in good standing with SACNASP, ECSA, SPEE, APG, and or a member of any other recognized professional organization. Yeah, have a minimum of 10 years practical experience in oil and gas engineering, geology, or geophysics, with at least 3 recent years of such experience in evaluating of reserves and resources. You will see that this is now out of line compared to the PRMS, because the PRMS used to have the QRE as 10 years only, but now they've got the QRA as 10 years and the QRE of 5 years. But we in SAMOG have agreed that we still want them to have 10 years experience, and we are debating whether we should get the QRE definition in line with the PRMS, or we should leave it as QRE, and I think we're going to leave it as QRE for the PRMS. Must be current and competent in the methods of practices of reserve and resource evaluation, and is conversant with the content of the SAMOG code. All reports should be prepared having taken into account the principles incorporated in the PRMS, as I have explained to you. Disclosure of reserves and other information must satisfy a minimum of the following requirements. Disclose the effective date of estimates. As we heard earlier, each date of estimation has got an effective date. That's the date on which it was true, and that has to be disclosed. Have been prepared by a QRE. Should have been prepared in accordance with the PRMS. Avoid misleading statements and discuss technologies, methodologies used to establish the appropriate level of certainty for these reserve estimates. Yeah, there are different technologies, and if you just give a number, it doesn't say enough. We require people to say what technology, what methodology was used to come to this number. That has to be reported. In the oil and gas industry, there are various ways to estimate the amount of resources in the subsurface. And if you just give a number and we don't know how it has been estimated, it's very hard for somebody to really verify that it's true and not, or how it was established. If reserves are booked without regard to the likely availability of funding required, they can only be booked under justified for development subclass. So you saw in the reserve subclasses, there was one subclass justified for development. And one of the contingencies is generally that funding has to be available. However, there's one category, justified for development, where you can book reserves if there's a very highly likelihood that funding will be available very soon. Then you can put it under justified for development subclass as reserves. If possible reserves are included in future net revenue, include a statement that possible reserves are volumes with a probability of less than 10% to be recovered. As I tried to explain The reserves have got three classes: proven, possible, probable, and possible. Now, the proven reserves have got a 90% chance of being recovered. The probable has got 50% chance of recoverable. And normally reserves are booked under probable events. So the probable events have to be economic. Then you can prove these reserves. But if you also want to book possible reserves, you've only got a 10% chance of recovery, then you have to state that very clear what the possible reserves are. So in the reserve statements and also in the bank, in the lending, reserve-based lending, banks will very rarely give funding for P50 reserves. They always will do it for the P90s, for your 1P reserves, very rarely for your 2P reserves, but you will get other investors who are happy to invest for 2P reserves. But to invest for 3P reserves is, of course, more risky, although they are still proven to be there, but it is only 10% chance you get it. So that's why we require them to state that they are possible reserves and you have to only a 10% chance to be recovered. Disclosure of reserves and information must satisfy the following criteria. This is the second part. That reasonable estimates of future abandonment and reclamation costs have been taken into account. We require that these costs are taken into account in our reserve bookings. You can't call volume reserves if they've not been taken into account. The aggregate future net revenue disclosure should comply with the requirements for this determination as specified in Form A. So the net present value should take 5, 10, 15, and 20% discount rates to show what your share is of the discounted net revenue. The statement of reserves and other information should be disclosed at the last day of reporting entity's most recent financial year. So generally we would require that the statement of reserves is at the last financial year, or if the last financial day of the financial year is more than 6 months ago, then it can be a new date of the financial year, but you have to state explicitly which date it is. If the reporting entity discloses anticipated results from resources, so not from reserves, but from resources which are currently classified, which are not classified as reserves, that's clear, resources are not reserves, the entity will have to describe the risk and the level of certainty associated with their recovery. So resources always have got contingency. So they can report on resources, but then we want them to describe on which contingencies these resources are depending. That has to be in the report. In essence, what I say here is, and it's quite funny, that we don't need any of your intuition jumbo jumbo. We need quantitative data. The only way to make a decision is to pull a number out of the air, call them assumptions, and calculate the net present value. But of course, you have to have the right discount rate. Well, that's of course the whole thing. In our uncertain environment, it's very nice to have all these numbers coming out of the air and be very pedantic about the discount rate. Yes, discount rate is important, but I hope I've shown to you that the uncertainty in what you can get out of the grant is much bigger than the sensitivity to the discount rate. So we just need to have the numbers taken out of the air much more justified than which discount rate we use. Okay, other requirements for us is disclosure of resources, sale of product types or associated byproducts must be made with respect to the first point of sale. So even the byproducts, like the helium we spoke about earlier as a byproduct, can only be used for the first point of sale. It is permitted to disclose resources at an adult point of sale, but then you have to have a very good reason why. You have to state which point it is and why you want to do it there. Yeah, state the disclosure is made at an alternative point, disclose where this alternative point is, and explain why you want to have that alternative point. Future net revenue, and I said fair market value. You know, the word fair market value doesn't exist. It's either fair value or it is market value. But disclosures of an estimate of future net revenue whether calculated without discount or using a discount rate, must include a statement to the effect that the estimated value disclosed is not represent the fair value or market value. It's just a discounted net revenue. And it has to have the consent of a QRE. Yeah, so the QRE has to stand behind this valuation. Disclosure of resources. If anticipated results from resources other than reserves are reported, the entity must disclose the quantity of holdings. So how much do we have? Where are the resources? The product type and the project description. Which projects will be done to convert resources to mature resources to reserves? So significant events and timelines, recovery technology, conceptual projects or pre-development projects you want to do. The recovery risk and uncertainty, and how was improved resources value calculated. So in unproved resources, how was it calculated? How much you want to get out? And is it independent or not? Independent from your company assessment or dependent on your company assessment? The estimates at the left must have been prepared by QRE, must be classified and categorized in line with PRMS again, and must be accompanied by the definition of the resource category used for the estimate. The effective date must be again there, the contingency which prevents the classification as reserve, and cautionary statements, the normal cautionary statements we discussed earlier. Okay, other requirements. We are allowed, according to PRMS, to use analog information. So if you haven't developed a project yet, or if you haven't got any ongoing production yet, but you've got an analog field somewhere, you can use the analog information to determine your reserves and your value. But then in this, you need to disclose the source and the date of the analog, whether the source and analog data was independent, and if the reporting entity is, so if the important entity is unable to confirm that the analog information was prepared by the QRE or recorded as PRMS, a cautionary statement has to be given. Yeah, the relevance of the analog information has to be stated as well. How relevant is it to your field? And then the net asset value has to be there. The reserve replacement. So in oil and gas, it's always very important to state reserve replacement. I produce a certain amount of reserves every year. Am I really replacing this amount or not? How much am I replacing? The netbacks, the oil and gas metric used for volumetric or value. So which metrics have I used for the not volume or value? Used if not volume or value. Sorry, I'm mixing things up. Oil and gas metrics used if not volume and value. So if you use other metrics, or if you use tonnage, you have to say why. Rules on disclosure of high case with obligation to disclose low and best case. So you have to say, how did I disclose the high case and why not the low and mid case? That's all for if you do the resources only. Must disclose a summation of the estimated quantities volumes of 2 or more of the following. So you cannot disclose these things separate from each other. You cannot disclose reserves, contingent resources, and prospective resources together, or unrecoverable resources together. I think that close here, you may disclose an estimate for total hydrocarbon in place, total hydrocarbon in place undiscovered, and discovered. Yeah, but then you have to include the reserves, contingent resources, and contingent resources. You have to disclose the sub-commercial portions of all these hydrocarbons in places as well, according to the PRMS. Yeah, and then, but you cannot add reserves to contingent resources to prospective resources and reporting that. You really have to add these classes separately. And then in the Form A, that's the form you have to fill out, that all the previous statements are in Form A. They're set up in several parts. I'm not going to go in detail there. But in essence, you just have to complete Form A and then issue Form A to the stock exchange. That's all I had about SAMOG code. But this was shorter than expected, Tanya, but I don't know if there are any questions.
Okay, folks, the floor is open. Anybody have any questions on SAMOG code or anything to do with oil and gas reporting for Peter? This is a great opportunity to ask anything that you ever wanted to know or understand about oil and gas exploration and reporting. Peter, they're also totally flawed.
Yeah.
Also wanting to know how you can report things that don't exist.
Yeah, that's always difficult. I think it's undiscovered. I think in oil and in minerals you've got the same. You think it's there, you haven't found it yet. But I think if you shoot seismic in minerals, you also see some faults, and you expect it to be there, but it has to be proven. So you drill test holes to that. We have to drill exploration wells. Unfortunately, our offshore exploration wells are a little bit more expensive than the test holes onshore for oil and gas or for minerals. So that is where the big money goes.
Yeah, that's so true. Okay,
Yeah, and that's where the value chain goes from play to lead to prospect. So it's a long time. If you get somewhere in an area, we first identify place based on geological models where we think that there is a source rock and a migration path and a reservoir and a seal. Once we have found these elements, either by fieldwork or anything, then we try to make leads based on some seismic surveys where we say, yeah, we can see some hints, and then we have to shoot more seismic over it in order to upgrade the hints to prospects. And I said, generally prospects have a probability of success of 20% only. So 1 in 5 success rate. And if you then make a success, then you come to your appraisal and your development.
Peter, would you like to unmute yourself and ask your question, please?
Yes, hi. Thanks, Peter, for the presentation. It's very interesting. If we had a pure helium play, how would you report that? You've been talking specifically about hydrocarbons at the moment.
Yeah, that's a very good question. I think we would, the PRMS doesn't deal with it. The PRMS very clearly states that helium should not be reported in the quantities, but in the value only. Because the quantities, PRMS says petroleum resource management play, and it's not helium. So in generally, helium has always been associated with other gases to date. And what we've got in South Africa is one of the biggest helium association deposits. I think normally helium is only in percentages of 1 or 2% helium compared to the other gas in there. And in South Africa, I think they go up to 8% at the moment, or 4 or 5%, which is very rarely to be found in the world. So I've never heard of a 100% helium play. But that is an issue we have been discussing in the SAMOG committee as well. And we in the SAMOG committee has agreed that we will report helium in the similar way as we do hydrocarbons. Yeah, just in the BCFs, but also in how much you think you can get out. So you've got your helium initial in place. And then from that initial in place, once you discover it, what is your recovery efficiency? Is your recovery efficiency going to be 10%, 20%, 80%, and why? And then multiply that recovery efficiency with the amount of helium in place, and then get your uncertainty on there from your 1P, 2P, 3P helium gas volumes you can produce. That's where we tend to go towards in the SAMOG committee at the moment. I hope it answered your question.
Yes, it does. Thank you. If you had a similar question on steam, for example, how would you manage that?
A similar question on what? Sorry, I missed it. I think my earphones are running out of battery.
Commercializing steam, if you had
okay, now you come to a very interesting thing. The UN has got has got a separate framework for resources. In the UN framework, they want to have all kinds of resources, mineral resources, hydrocarbon resources, energy resources, all in a similar way. In the UNFC, that is framework classification, deals with the similar ways. And they classify steam and all kinds of other energies in a similar way. But they've got a 3X evaluation system where they look at the risk, they look at commerciality, social, and then look at the environment. And in this three-way commercialization, you can classify steam, you can classify hydro, you can classify nuclear, you can classify all minerals and all kinds of other things. I left that classification out of my presentation, but they are really going ahead by bringing this more to the global public to start using it for planning, for forward planning. So steam in the PRMS would be quite difficult to use it, but you can use it in the UNFC framework.
Thank you.
Okay, there's a question on the chat line for you, Peter.
Okay.
Mark Turnbull says he's not a geologist, but probabilistic reporting of reserves and resources makes more sense. Could this possibly be applied to other solidified commodities?
No, yeah, I hope sincerely. The oil and gas industry in the past never did probabilistic until they realized they were getting much better results and much better feeling for the uncertainty we're dealing with by using probabilistic. And over the last, I think 15 to 20 years, the probabilistic reporting became more in, and it's now really fully accepted in the oil and gas industry, and people are much more confident with it. So I hope that in the other solidified industries and other industries, it is starting to be used as well, because it's a different way of thinking, but it helps you understand your risks and your probabilities much better. It helps you also better communicate to your investors what they're letting themselves into. And I've got a big issue at the moment with my investors, because even with my stakeholders, the Central Energy Fund, they just want to have one number for which I can guarantee them that I can find this amount of hydrocarbons. Now, if there's only one number I can guarantee them, it's going to be a very, very low number they're going to get. But it's not doing benefit to the business, because you will never get commercial projects if you only want to have a number which I can guarantee them. Yeah, I only can give them very low numbers. And because then they will never take any risks, and all our business is always by taking risks and potentially getting something out of it. So I fully agree with you. It would be very good to get it into other industries.
Thank you. Anybody else? Any other comments? Going once? Going twice? Sold. Peter, thank you very much for your presentation, and thank you also to Andy MacDonald and to Vaughan Duke for their time and experience today. We much appreciate it. And thank you all to the delegates for being with us for our third day. Next week, we look at the more practical aspects of JSE compliance and listing rules. And we look forward to seeing you all back, same time, same place next week. Thank you very much.
Okay, thank you very much.